In New York City, I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco.
Stock futures are in the green this morning, working to recover after yesterday's big sell-off. You've got the S&P 500 coming off its worst day in nearly 2 years. A number of factors, including that weak jobs report that we got out last Friday, have prompted investors to sell. So what's next? Let's get right to it. The three things that you need to know to start your trading day. Yahoo Finance's Josh Schaefer, Dan Halley, and Jared Blickery have more.
Hey, Shauna, stock futures are in positive territory after a two-day sell-off. Markets are recovering some ground after that weaker than expected jobs report sparked fears of a U.S. recession. Now, San Francisco President Mary Daly says a slowing job market isn't necessarily a cause for alarm yet, while also declining to make predictions about when the central bank will start interest rate cuts. The majority of traders are now pricing in a 50 basis point rate cut for the Fed's September meeting.
And we're keeping a watchful eye on the tech trade this morning. The sell-off hit the sector hard, pushing the Nasdaq Composite further into correction territory. Magnificent Seven stocks collectively lost $650 billion in market cap on Monday. And Alphabet is front and center this morning, the stock regaining ground after the sell-off, but a judge found Google's search and ad businesses violated antitrust law, which could reshape how the tech company does business moving forward.
And shares of Palantir surging after the company reported second quarter earnings that beat Wall Street expectations. The company also raised its full year guidance thanks to continued demand for its artificial intelligence software. Overall, the results followed a slew of business wins. The company closed 27 deals over $10 million, growing its customer count 41% in the last year. The stock is up 40% year to date.
Our top story, stock futures recovering some ground this morning after the S&P 500 and the Dow posted their worst sessions in nearly 2 years on Monday. Nasdaq 100 futures also in the green as the tech-heavy Nasdaq lost 3% yesterday, slipping further into a correction. Contributing to the two-day sell-off was a weaker-than-expected monthly jobs report on Friday, prompting recession fears and questions about whether the Fed has waited for too long to start cutting interest rates. A number of analysts also attributing the moves to an unraveling of the yen, carry trade as it's called, and high valuations.
And as we see stocks regain some ground here less than 30 minutes before the opening bell, investors are questioning what's next. Earnings are rolling in and more inflation data is on deck. You've got the CPI and PPI prints are due out next week. As it stands now, over 70% of traders are pricing in a 50 basis point cut at the Fed's September meeting. So lots of questions about what exactly the Fed is going to do next. That has been really the question I think a lot of people are asking, whether or not the sell-off that we saw play out over the last couple of days, but especially what we saw yesterday in the wake of the unwinding that we saw overseas, specifically in Asia, that was a bit of an overreaction, judging by at least today's initial moves, and especially what we saw overnight play out in Asia. We do seem to be set to see a bit of a comeback here. I think the question, though, is what exactly that snapback is going to look like, whether or not it is going to be more of a turnaround Tuesday, which when we do see selling on Thursday, Friday, and into Monday. Tuesday tends to be called that turnaround Tuesday. It looks like we are on track to recoup some of yesterday's losses, but again, to the extent, I think, is the big question at this point. And also, when you take a look at the unwinding that we did see in yesterday's market action, we are well above that 200-day moving average for the S&P. We are well above some of those critical support levels that we had spoken to from a number of technical analysts there yesterday in today's trading day. So again, it looks like at least the setup in today's trading more encouraging, obviously, than what we saw yesterday. But I think to the extent that this can hold on is a question right now. And then as you look ahead, not even to next week, but even that jobless claims report that we're going to get out on Thursday morning here before the bell, I think that's also going to be a critical test here for the markets, whether or not we do see continuation of that softening and maybe ultimately what that then signals for the strength of the U.S. economy. Yeah,
that weekly jobless claims number starting to give us a little bit more of that pulse, weekly pulse, than the monthly. And that's something that we saw in similar contractions, particularly back in COVID and that really the volatility perspective actually that we're seeing a lot of comps go based off of right now. But I think you're right to call out what we're seeing more internationally and in Asia Pacific specifically. And I was looking through how BlackRock is actually looking at this market backdrop right now, pointing to some of the Bank of Japan policy shift also mattering for the global term premium. They're saying that that also is a potential greater risk for a policy misstep, reviewing their overweight to Japanese stocks. Additionally, this is a big week here in focus for Chinese exports, and the economic data that we could see coming out of Asia Pacific could really move the trade, especially for some of the most internationally exposed players in the equity markets here in the U.S. So that's one area to keep a close eye on, even as we get towards weeks from now, Nvidia's earnings as well, as they're going to be looking into that region to see exactly where they can continue selling in, knowing that it has to be a different type of chip that they're pushing into China.
All right, when we talk about the movement that we've seen play out in the markets here over the last several, 24, 48 hours here, at least in terms of trading days, let's take a look at where the yen carry trade stands right now, because we are seeing some recovery in the dollar from yesterday's slide after weak economic data last week spurred some recession fears. The U.S. dollar moving higher against the Japanese yen. Yahoo Finance's markets and data editor Jared Blickery has that breakdown for us. Jared.
Well, thank you, Shauna. It's a great time to be talking about the yen carry trade. Here we have Tokyo is up 10%, and this is a huge amount for any stock index around the world. But Nikkei has been, or was, I should say, the best performing index of the year. But let me show you over the last 3 days, it's actually underwater because the scene of the crime Sunday night was over in Japan, where the yen was strengthening to a large degree. And that's a big reversal of this, what we call the carry trade. And that's basically Japan had negative interest rates for years. There was a huge differential with the U.S. And so people would borrow in the yen, and then they would invest it in higher yielding currencies like the U.S. and even emerging market countries. But that trade right now is unwinding. JP Morgan estimates that about half of it is done, which means half of it is yet to be undone. Are we going to see some of the same disruptions that we've seen in the market? Arguably, the worst should be in the rearview mirror unless something else breaks. It seems to have been a Japan problem with leverage, and it's spread across the world, but really hasn't sunk its teeth into the U.S. just yet. Don't tell that to investors, but we're not even seeing a lot of the U.S. indices in correction territory just yet, Nasdaq notwithstanding. What I'm showing here is about half of the yen pairs appreciating today. Let me just show you a 3-day view so you can see the yen is still a lot stronger than it was, and that's still putting some pressure, but eventually these things work out, and the question is, how much does it bleed into U.S. risk assets? We just have to wait and see.
All right, Jared, thanks so much. Let's talk about some of the moves that we've been seeing in the markets here, because it's turnaround Tuesday here for the markets. Futures are pairing some of those losses, poised for a comeback after that 3-day rout that we've been talking about. Traders now pairing rate cut bets as yields rise across the curve. For more on this, we want to bring in Seema Shah, Chief Global Strategist at Principal Asset Management. We also have Scott Wren. He's a Senior Global Market Strategist for Wells Fargo Investment Institute. Great to have both of you here. Seema, let me start with you. Just when you take a look at some of the buying that seems to be happening here ahead of the open, it looks like we could be set for a turnaround. I'm curious, what does that tell you about the movement that we saw yesterday and whether or not the extent of that selling was a bit of an overreaction?
Thanks for having me on. Yeah, I think yesterday what we saw was, I think, a valid reaction in some sense. But I think the expectations about Fed potential loosening was very, very aggressive. Concerns about recession very much overdone. So what you're seeing now is a little bit of a kind of a reality check of maybe that actually the economy concerns are not as bad as had been expected, but you do still have some of the technicals unwinding. And you mentioned the carry trade before, that's probably got a little bit further to go. The key thing for markets, so always for anything, is the speed, the kind of the ferocity of any kind of moves. And I think that was what was damaging over the last 48 business hours. So it's hopefully seeing the yen appreciation slow down and stabilize, and that should, I think, maybe at that point start a sustainable floor for the market.
Scott, I want to get your perspective. Was yesterday an overreaction, too much of one move to the downside, given what we've seen over the course of the past couple weeks here, the Fed really needing to take into consideration, and the markets being concerned that the Fed might be behind the 8 ball right now?
Well, Brad, it certainly happened quick, and we do not think we're going to have a recession. Don't think the Fed's behind the eight ball. You know, the carry trade unwind probably had something to do with it, but just, you know, the fear that gripped the market after last Friday's report that we were going to have a recession. So I think, you know, what we're trying to do, number one, you know, a big part of our job is, you know, you project the economy. So is growth going to slow a bit? Sure it is, probably for the next few quarters, probably improves in the second half of next year. So the question is what are you doing and about it? And so this morning, you know, we announced some adjustments. Basically, we're taking money out of short-term fixed income, which was a parking spot for us. We took money as the market was going up out of communication services and tech, parked it there, trying to be patient, waiting for a pullback. Putting that money into large cap, into small cap. So we're making some maneuvers here because we think you have to take advantage of this. And Sean had mentioned that 200-day moving average in the S&P. It's, you know, just above 5,000. Wouldn't surprise me at all if we touched that. So we're not trying to pick the exact bottom, but we're trying to get positioned here for what we think is going to be a better equity market between now and the end of next year.
So Scott, given that, I'm just curious, and this kind of goes back to what Seema said there in her first answer, just the speed at which we saw the selling yesterday. What does that indicate to you just about some of that weakness, or maybe what it signals about the coming volatility that we could see over the next several weeks?
Well, I think anytime that there's uncertainty over, you know, what inflation's going to do and what the Fed's going to do about it, that plays into things. And, you know, you never know exactly how much the carry trade had on, but, you know, you keep hearing numbers, you know, 20 trillion, something like that. Well, you know, that's 4 times the daily average of global foreign exchange, you know, transactions, which is about 5 trillion a day. So, you know, when you have a lot of people leaning the same way, and all of a sudden, you know, the bottom starts to fall out. You know, it's just a get me out trade, and that's when you get these big, quick moves. People are panicked, but as long as you think you have a good feel for, you know, what's likely to play out in the economy over the next 12 or 18 months, if you think it's good, then, you know, you want to take advantage of that, and that's what we're trying to do. But the speed is always what scares people. But if you have a plan, you know, you have to kind of cut through that and, you know, execute the plan and step in when you think the time is right.
Seema, with that kind of speed and declines that we did see, does that prompt any rotation from your perspective that investors should be thinking about ahead of the open this morning?
Well, I think to Scott's point, I think the point is over the last couple of days, has anything happened which would change your perspective on where the market is going? Now, we are expecting the US economy to slow, but we're not expecting recession. We're expecting the Fed to cut rates, but again, not to have to cut rates aggressively. So from that perspective, actually, the backdrop hasn't really changed for us. So we have maintained the risk on positions, but again, really focus on some of the more quality assets, a little bit more focus on defensives. I think what's been interesting, and I think a little bit uplifting through this, is that one is that credit spreads have stayed fairly stable. So that adds to that idea that fixed income is there to provide that stability into portfolios. And also treasuries have rallied, and that hasn't always been the case in the last couple of years when we've had moments of panic. So I think that's been really reassuring, and it should be a good reminder that, look, you have, you know, equities, they certainly look strong in a growth environment, but there's always a time to have fixed incomes, particularly if you have any kind of downside economic risks facing you.
Seema Shah, Chief Global Strategist at Principal Asset Management, and Scott Wren, Senior Global Market Strategist for Wells Fargo Investment Institute. Thank you both for joining us ahead of the opening bell.
Thanks, guys.
Thanks. Zeroing in on megacap tech, although we're seeing investors question when generative AI will result in revenue for a number of big names, there are still those that are seeing big buying opportunities in the sector. Here with more, we've got Yahoo Finance Markets reporter Josh Schaefer. Hey, Josh.
Yeah, Brad, so to just put this move in perspective for you, looking at some of the large cap tech companies we were just showing on your screen, if you looked at Nvidia, Microsoft, Alphabet, and Amazon, those are now all off more than 15% in the last month. And some of the larger equity strategists we follow and research teams that we follow are starting to come in and say maybe it's time to buy the dip. Maybe there's a little bit of an opportunity here. So BlackRock Investment Institute wrote last night that they're still overweight U.S. equities driven by the AI megaforce, and they see the sell-off preventing buying opportunities. They essentially think that the recession concerns that are going around the market right now are overdone. Evercore ISI's Julian Emanuel has the highest price target for the S&P 500 on the street right now at 6,000, still hammering that AI trade right now. He wrote, "We view the current AI air pocket as an opportunity to gain exposure to a long-term secular theme." Guys, I think the takeaway here from both BlackRock and Evercore is don't let 2 days of market action sort of shake what your overall strategy was. They're not going to let a little bit of economic data and a little bit of a shift in the narrative here sort of change what, again, they think is a secular theme. Secular theme, we're usually talking pretty long-term, right? So if you're a long-term buyer in that AI theme, they think it's still constructive to be getting in at this point.
I'm curious what you've made with the many conversations that you've had with strategists here over the last 24 hours or so. What do they think is going to be the catalyst for that turnaround? Are they looking for more, maybe some reassurance on Thursday when you take a look at the jobless claims as you look ahead to inflation print, or is it more maybe the technical-based bounces that we could be seeing based on the broader indexes?
It's both, depending on who you talk to, right? There's a lot of people that want to look at the VIX right now and say, well, the VIX is above 35, it's moved as standard deviation. We could start going into really technical things, but essentially when you have that big of a vol spike, it's going to take a little bit to settle. Then you mentioned the macro data. Not great this week for much of a catalyst. Yes, jobless claims, sure, but I think you need to wait another week. You might need to wait until Jackson Hole to get a better feeling. Maybe it's Nvidia earnings, right? Because one thing that was pointed out that I found interesting, this was from the team over at Goldman Sachs, they were just simply looking at earnings estimates for these companies, and you've seen the price come down, right? But earnings estimates since June 30 have actually held up pretty good. They're up for everyone except Microsoft. That's what you're looking at on your screen now. This is forward EPS for 2025 consensus revisions. Those are still on the rise. So what you're looking at is prices coming down, earnings estimates are going up. If we're going to do a basic valuation analysis here, the stocks are getting quote unquote cheaper. They're not quite cheap enough. If you're looking at a long-term median, Goldman said they're at a 27p instead of a 24p. So maybe I think there's a little bit more of a pullback that some people are waiting for in big tech. I don't think there's a lot of people saying this is the bottom. There was not a lot of people. There were people saying they want to nibble yesterday, but no one is saying we feel like this is all over. This is the bottom. It seems like volatility for the rest of August and some chop probably leading all the way into that Fed meeting, honestly, is what most people are looking at this point.
Well, volume has something to do with it too, especially if you have a certain amount of traders that are away from the desks. There's not the same amount of
people
flows
still got to go to the
seeing.
beach, Brad. Still August.
They got to take the last couple
going
weeks
to the beach
of August
still.
off. Yeah. I know.
Yeah,
We know you're going to the beach, Josh.
Got to work on that tan. Got to work on that tan. Come on, guys.
Every day, exactly. All right, Josh, great stuff. Thanks. Let's take a look at a big mover here this morning, and that is Palantir. Shares are moving higher after raising its full-year outlook on strong demand for its AI software. You're looking at gains of just about 13% ahead of the open. The company CEO, Alex Karp, saying in a letter to shareholders that its AI platform has, quote, transformed its business. So, as we have seen with Palantir specifically over the last several quarters, that they do mention AI, talk about how AI is improving their business here. We have seen investors in Wall Street really react favorably to those results. Digging down into this a little bit, we know that Palantir has recently expanded its commercial business. Commercial sales were up 33% from just a year ago. Government sales were up 23% from a year ago. So again, it looks like, and Alex Karp also went on to call this a quote unquote historic earnings report here for the company. So again, it looks like the street is at least encouraged as by what AI is doing for Palantir's business, see some hope in terms of driving that further earnings growth down the line. And as a result, you're looking at Palantir climb back from yesterday's losses and also add some, it looks like, here in the pre-market.
Yeah, they said on the call that their results are a reflection of a market that is quickly awakening, they say, to a reality that their customers have already known, standing alone in this ability to deliver AI enterprise production impact at scale here. And overall revenue growth, excluding some of those strategic commercial contracts, that accelerated to 30% year over year and 10% sequential in the second quarter, and ultimately driven by the strong execution, they say, in their U.S. commercial business and then continued U.S. government business acceleration. An upgrade, I would say, on the vibes. There was no mention of war. I at least didn't hear anything to that end on the earnings call, so happy to have that behind us. But still, one of the major concerns here for a company that has a lot to do with making sure that they can secure government contracts. Those governments obviously trying to tap into Palantir in order to make sure that they've perhaps got the best ability to circumvent any type of threats that may head their way, whether that's war-related or not.
Yeah, Alex Karp going on to say that, quote unquote, the world is on the precipice for what could be a very severe set of violent interactions in the Middle East.
We didn't hear the word war, so that's good. But yeah, no, that's not good. Anyway, coming up, everyone, shares of Uber moving higher after posting strong growth in bookings for its mobility unit during the second quarter. We've got some more top movers for you on the other side of the break. Time for some trending tickers. Uber shares moving higher this morning after seeing its second quarter revenue rise 16% from a year ago and reporting a 23% jump in gross bookings in its mobility unit. There you're taking a look at some of the actuals versus the estimates. It was beat on top and bottom. And one of the figures as well here, a few of them that are noteworthy. I mean, they were pretty much up in just about every kind of core metric that they typically report out to the street. Monthly active platform consumers, that was up 14%. Number of trips up 21%. Gross bookings up 19%. Revenue up 16%. All this considered, they did see some weakness in freight, but that was really the only kind of blemish here in a broader, just all out beat, I would say, pretty much on most metrics.
I think the takeaway for me in this earnings report was the fact that it returned to profitability. We talk about last year was the first year it had turned an annual profit as a public company. It fell into losses during the first 3 months of the year. So here we are during the second quarter of 2024, and we've seen a profit of just over $1 billion. So again, that is encouraging here, obviously, to the street. When you take a look at gross bookings, and that includes ride hails, it includes delivery orders, driver and merchant earnings, that's also trending in the right direction, like you're talking about there. That growth of just about 19%, just under 40 billion here in the 3 months ended in June. So again, when you talk about some of the trends that are now back on track, it looks like here for Uber, I also think it's going to be interesting, and we got some of this in the guidance as well, but also just what this tells us about consumer spending and the shape of the consumer right now, because we talk a lot about a deterioration there, those stocks that could be poised to take a hit if we do see a bigger pulling back. When you take a look at these numbers, it actually points to a relatively strong consumer, right? People are still out there spending. They're willing to pay up for Ubers right now, and again, or they're willing to order out and get Uber Eats, and so again, that really I think paints a maybe more clear picture that yes, there are some reasons to be a bit concerned, maybe about some of the softening that we have seen in the economy, specifically when it comes to the labor market. But all in all, right now, you're still looking at an economy that is on relatively stable footing.
It's your designated driver, Uber is. I mean, and all of the ride-sharing platforms. I mean, if you're going out on the night, on the town, but whatever. Anyway, taking a look at Uber, and one of the other things that they had announced coming in to this earnings report here, this partnership with BYD and how they're going to look to put 100,000 cars within this, or electric cars on the road as part of their own perhaps movement towards their autonomous taxi service here. One day we'll potentially see that. But we remember when Tesla made those announcements on their earnings call, Uber, it declined precipitously and saw a huge drop. And so now having this announcement going into the earnings, which we just broke down, it'll be interesting to see how they're able to compete on a taxi service front on the autonomous element, and how many drivers tap into that. I'm not going to be the first one, but I'll take one eventually.
Yeah, and I think that's exactly the question, right? How many people are going to be willing? And I think once this gets underway, there's going to be more people that are willing to take a chance and do that, maybe than's currently being factored in. But again, Uber really highlighting that during their presentation after the bell yesterday. All right, let's take a look at shares of Caterpillar, because they boosted its annual profit forecast despite a decline in sales from a year ago. You're looking at shares, there are off in the red here, but at least on a 1 year basis, you're looking at a gain of just about 14%. They closed the day yesterday off just about 1%. We're declining a bit more here in early trading, but taking a look at this and maybe why we are seeing some of that initial move fade just a bit here ahead of the open. The fact that its revenue did miss estimates, this might be a warning here to investors just that are worried about an economic slowdown. We talk about Caterpillar being a bellwether here for the economy, so the fact that they did miss on sales, it looks like that's what the street is taking issue with. And then, of course, the question is what this ultimately signals here about where we are in the earnings cycle.
I mean,
the economy.
Right, exactly. The volumes were down in every category. Construction was down, resource was down, energy and transportation sales volume also down, and then all of the other segment and corporate items and eliminations also down. And so all these thought about by the investor as one of the major kind of demand environment hits, to your point, as you were mentioning a moment ago here. And as we're thinking about, how this is also going to impact some of the margins that they see. You can't push price through forever and expect volume to remain the same. I mean, I don't know what the replenishment rate is on one of the tractors from Cat, but at the end of the day, I think the investors are going to be looking closely towards this operating profit margin. Adjusted operating profit margin was actually good year over year. Came in at 22.4% for the second quarter of 2024. You compare that with 21.3% for the second quarter of 2023, but that's because they had to push through price. So it'll be interesting to see how much more price they can push through before the demand environment really starts to deteriorate further.
All right, well, we are just minutes away from the opening bell on Wall Street. Again, taking a look at the major averages, it looks like we're set to open in the green. A bit of a rebound from yesterday's massive sell-off, although a ways to go as we talk about regaining some of that momentum. We're going to speak with a strategist on the other side.
I'm pumped. All right, we're taking a look at the opening bell on Wall Street and in Midtown Manhattan at the Nasdaq. You're watching the Morning Brief, brought to you by Invesco. We've got some great bell ringers, Neurogene getting some funfetti at the Nasdaq, and you've got the Greenwood Project ringing the opening bell at the NYSE. All right, great bunch of folks there on both sides here. Let's take a look at the markets as we kick off today's trading activity. We are mixed right now. We're seeing, actually, there we go. That's calibrated. We are seeing gains across the board. I was wondering what would happen. What had happened for a second there. But anyway, the Dow flat, just barely to the upside. We'll see if we can hold on to those gains. Got a long trading session ahead of us to try and rebound from yesterday's deep declines for the Dow. The S&P 500 right now, that's higher by about 0.3%, and the Nasdaq Composite up by about 0.4%. Just as quickly as I said it was in positive territory, the Dow now in negative territory.
Yeah, exactly. We're right around the flat line there. I think it's too early, obviously, to tell just what direction the market is going to go. There's lots of worry that's still creeping in and still in the markets, especially following yesterday's sell-off and the losses that we saw on Thursday and Friday. I also want to pull up the Russell 2000 if we can and take a look at the small caps because we had talked so much about this rotation into small caps ahead of that 3-day rout that we had been seeing. So here we are today. We're looking at another day of losses, and when you take into account the losses that we've seen over the last 3 days, we are now off over 10% than we were at the start of the trading session on Thursday. So again, where we closed on Wednesday. So we've seen a bit of a reversal there, along with the weakness really across the broader market. So again, questions about whether or not the rally that seemed to be taking place in the market, if that is something that's going to hold. It doesn't seem to be, at least at all now. But again, questions here as we talk about what is ahead and what investors need to be prepared for in the coming trading days. Yahoo Finance's Jared Blickery is a closer look here at what is moving. Jared.
You know, Shauna, it was pretty frightening yesterday, but nevertheless, the S&P 500 not even in correction territory just yet, meaning it's not down 10% from its record high. And just taking a look at the Dow over the last 2 days, you can see, yes, we were bouncing back a little. Actually, we're in the red right now, still down 2.6% over that time. The Nasdaq, and let's see if we can maybe get a 2-day chart there, still down almost 3% over that time, even though it's bouncing back about 55 basis points today. But the indices themselves have not really gotten off to a great start this month. In fact, it's the worst start to any month for the S&P 500 and the Nasdaq since 2002, quite some time ago. And we just had this huge shock yesterday. I'm going to show the VIX one more time because I think it's important to show on a relative basis how big that spike was. This is a 20-year chart. I'm going to put candlesticks in so you can see all the action there. And we had the biggest spike, the third biggest spike, hard to see there yesterday, that we've had in the index since 1990. Then you take a look at what's happening with the bond market, where you have yields bouncing back after the drubbing that they took yesterday, but they started climbing back yesterday morning. So there was already a recovery underway. So with all that in mind, just want to show you what's happening in sector land. Tech, XLK, that's up 1.6%. That's leading the way. Then after that, we have staples and industrials. Those are the ones that are outperforming. Real estate, the only sector in the red. But I want to show you what's happening over the last 2 days. And you can still see there's a lot of territory to potentially be reclaimed there, guys.
All right, Jared, thanks so much for breaking that down. Well, stocks right around the flat line, and at least for the Dow, we're looking at gains, it looks like, for the S&P and the Nasdaq. You know how the Dow back above, right as I said it, now it's below the flat line. Well, the tech-heavy Nasdaq leading the drop this week. It is down just about 5%. The Mag 7 shed over $1 trillion in market cap over the last 3 trading days. So here to discuss what could be next and how you should be adjusting your portfolio, we want to bring in Aaron Dunn. He's Morgan Stanley's senior equity portfolio manager. And Aaron, when you take a look at the selling that had played out over the last 3 sessions, here we are shortly after the open. We are seeing some buying activity. How should investors be thinking about today's trading setup and what exactly we could see here going forward?
Yeah, I'm not surprised to see the market bounce here. You're kind of 3 days into the sell-off. The other thing I think that's very interesting is, it was alluded to earlier, really since late July, the market's been in a little bit of a correction mode, but we're not, we're only down 8-9%, including today, and we're still in an uptrend for the market, right? So to me, there's been a lot of sensationalism around all the stuff going on, and really a lot of that's in Japan with the carry trade. In the U.S., we've come off, and the issue with, in my view, the market has been something that's been talked about for a long time, which is the concentration of all these indices, right? I mean, the top 6 tech stocks still account for about 30% of that index. So they drove a lot of the upside returns. And what that means is when you get really highly volatile tech stocks that account for that much of the benchmark, the downside, volatility will occur. And we've had 9-10% pullbacks along the way here. But, I think the market remains in this uptrend. Now, we've had weaker employment numbers. We've had a softer ISM. There's been some softness that obviously has made its way into sort of economic data. And how does an investor, I think we're at an inflection here, and I think investors should look at that. We always advocate a balanced sort of approach to the market in some ways, and timing the market is extremely difficult. So, using this opportunity to probably, maybe take some out of bonds, which have had a nice rally here, and reallocate to equities, I think is a prudent action.
It's interesting, Aaron, because if we look at the Dow and many of the major averages right now, there's going to be, even within that uptrend, perhaps some higher lows that we're going to have to track up against in order to make sure that we don't break through some of those support levels. Where is it critical for investors to be keeping an eye on those levels to make sure that we're not actually going to see even more of a rapid move to the downside? Because then the algos, it seems like, might start to enter into the picture as well.
Yeah, and the one thing we don't know about is, the thing that always that unravels many of these rallies is leverage, right? And so how much leverage, and we've seen that in some of the banks, a lot of the margin numbers for a lot of the brokers had really ticked up. So there's clearly added leverage in the market, and that can exacerbate the downside. For me, I look at earnings, for one thing. I think have remained reasonably resilient. It wasn't the best earnings season we've seen. But there were some kind of holes there, but it's been okay, right? And profits have held up. I think one of the things to watch for me is global sort of liquidity getting a little better as you have a concerted central bank easing cycle coming. Europe is probably very likely to do that. Great Britain did that. Australia eased rates. U.S. very likely begins to ease rates here in the fall. So that obviously should help the economies and take some of that restrictive policy. So I remain reasonably constructive on earnings. I don't think we're going to see a collapse. And I think what we're coming off is exceptionally good levels to pretty good at this point. And so I think it's something to watch, but it's certainly something to, I think, reallocate capital to.
It seems like, as with some of the earnings season past, one of the major bellwethers is once again going to be Nvidia, but can Nvidia alone save the markets from some of the decline that we've seen right now that have become more concerned with artificial intelligence and major CapEx spending not materializing quickly enough into returns on those investments?
Correct. And I think that's the other piece of this, and that gets to that market concentration issue is, can U.S. equity markets work when the biggest caps, and they are very volatile, aren't doing so well? And I think that's the challenge. We've sort of been pointing to that for quite a while. And you're right, there was a lot of question marks around AI. We've had those for a long time. And really the issue is use case. Like, what is the benefit of AI? I think we can all argue in the long term, there's likely to be some benefits, but it's going to take a while to develop. And so the companies, as you point out, have really thrown a lot of CapEx at growing data centers, growing their capabilities in the cloud and generative AI and machine learning, all this stuff. But we need to see the benefit of that. And I think the productivity numbers, if you look back to sort of 2020, 2021, the productivity numbers in the United States really diminished quite substantially. And that led to a lot of the unit labor costs going up. Now I think you're starting to see productivity improve a bit. And this is where AI could really play a role. Can Nvidia, can investor look ahead enough to own Nvidia for something that, in my view, probably will take a couple of years from a productivity standpoint to really benefit corporate bottom lines? That's the big question mark. It requires a lot of CapEx. People love these stocks in part because they've actually taken part of what the consumer staple industry used to be, which was a more stable business with fantastic balance sheet, right? All these companies have a ton of cash, and so that helps them to weather sort of higher CapEx cycle without, with growth coming in the outer years.
Aaron Dunn, who's the Morgan Stanley Senior Equity Portfolio Manager. Thanks so much for taking the time here, Aaron.
Thank you.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief.
Vice President Kamala Harris has reportedly selected Minnesota Governor Tim Walz as her running mate for the 2024 presidential election. The official announcement is expected to come sometime this morning. Here with more, Yahoo Finance senior columnist Rick Newman. And Rick, we have been waiting now for weeks speculating on who she is going to pick, and it seems like Walz is going to be her running mate.
Yeah, we can all go back to our normal lives now. The Veep stakes is apparently over. Yay. So Tim Walz, the governor of Minnesota, he's a sleeper candidate. He was on nobody's list at the start of this process. And apparently, the reason that Kamala Harris got interested in him is he's the guy who created the weird meme about the Trump campaign. So he did an interview on CNN just as a surrogate for Kamala Harris. And somebody asked him about Trump, and he said, well, I hear Donald Trump talking about Hannibal Lecter and all this stuff, and it just seems weird. And weird caught on, especially on social media. So maybe that's why she picked him. But to be honest, he has a real solid resume. The one factoid I just learned this morning is he will be the first guy on a presidential ticket, first person on a presidential ticket since 1980 who did not go to law school. His profession before he got into politics was a teacher, and he spent 24 years in the Army National Guard, and he's pretty popular in Minnesota. So he's the guy. The one interesting side note here is he doesn't represent a swing state. So Kamala Harris did not pick, obviously, the governor of Pennsylvania, which is a state she has to win. So she decided not to make that move of picking a governor who might help her win a crucial swing state, that is his home state. But obviously, she thinks Tim Walz will be the guy who can generate support for her in the Midwest, where she needs a lot of votes and all the swing states.
Rick, as investors and business profiles are perhaps trying to get around, okay, where ultimately do they need to understand how both of these parties, but their candidates specifically, are going to really kind of align themselves on issues that are going to impact business? You know, where does Walz kind of lean or teeter towards?
Well, if you're asking me if there's a Walz trade, no. don't try to trade the vice presidential picks here. Tim Walz seems to have cred with progressives. Bernie Sanders likes him, for example. He has a lot of support among unions. But he also just seems like a regular guy, and this is important in Minnesota. His approval rating among independents in Minnesota is 47%. That's pretty good. That's not off the charts. But independent voters in about 6 or 7 swing states are going to be the ones who determine this election outcome. Broader picture, guys, Kamala Harris is doing great so far, honestly. There are now national polls that basically show her tied with Trump. There are a couple of good polls that show her ahead of Trump. So this momentum is real, and I think Tim Walz is a guy, he's not going to cause her any problems, the way J.D. Vance seems to be doing for Donald Trump. And this ticket, the Harris-Walz ticket, they're trying to shape themselves as the nice guys, the normal people. So that's how the messaging, I think, is going to play out during the next several weeks.
Some large businesses as well that call Minnesota home, companies like Target, Siemens, United Health. You've got 3M. Best Buy up there, 3M. So we'll see how those organizations and their CEOs as well speak out about the general election coming up in November. But of course, a lot of movements ahead of that time that we've seen over the past few weeks. Rick, thanks so much for breaking this all down.
Bye, guys.
Appreciate it. We're tracking Nvidia shares this morning. Nvidia, the ticker symbol up on your screen right there. The shares are moving to the upside today after leading the declines in the Magnificent Seven yesterday, Monday, with those stocks shedding over $650 billion amid a steep global sell-off. The stock's volatile run over the last month here is leaving investors wondering if now is the time to buy. Let's bring in Patrick Moorhead, the founder and CEO of More Insights and Strategy, joining us now here. All right, so Patrick, I mean, is now the time to, if you're not already involved in some form or another and have exposure to Nvidia, is now the time?
Listen, giant sell-offs are always a huge opportunities for investors. When I stand back and When I look at the PE ratio, it's reasonable when you consider the growth rates. Their midterm competitive position hasn't changed from anything. And when I look at short term, there is a little bit of risk here with this potential Blackwell push, which is the follow-on to their H series. But customers can still continue to buy the H series. So even on the short-term risk, I don't see a tremendous amount of downside here.
So Patrick, I'm curious on what you attribute just the volatility to. It sounds like it's a bit of an overreaction. It sounds like you think that any sort of hiccup here, if we do see that in production, is going to be more of a short-term blip. Was this just a stock, just given the massive run-up that we've seen, which is primed and positioned here for this type of pullback, and then therefore, kind of going to your thesis of what you just said, it maybe does present a buying opportunity then for investors?
Yeah, you nailed it. I think on one of your previous shows, I even used the word hiccup. I mean, investors, that this stock was so hot for so long that any type of hiccup or bad news could mean a sell-off. And you add to what happened over in Japan and some other risks that melted the entire market. But you have to stand back and look at the overall short, midterm, and long, and then align whatever investment strategy you have with those opportunities and risks. I don't see anything changing in the data center for Nvidia for the next 12, maybe even 18 months. There is a little bit of short-term volatility until we understand what exactly is happening with Blackwell, which, by the way, could be an opportunity for AMD short-term, Broadcom, and maybe even Marvell to go in and grab some share. But that's a short-term, not a midterm, and then long-term, right? It's a totally different conversation.
It seems like some of the market's focus is going to shift towards China's economic data that's coming out this week. And the reason why I bring this up is this is going to be a pretense, perhaps, for the Nvidia earnings once they finally do report, given the significance of that region and continuing to tap into being able to put a specific chip for China made for that region into Asia Pacific as well here. What do you expect the reality of the pulse as prescribed via Nvidia to be about China and that market?
Well, it's kind of good news, bad news. The bad news was that earlier there were big restrictions and currently restrictions on companies like Nvidia, AMD, and Intel. And when you step back, because they're not participating, irrespective of what's going on with the China economy, it doesn't impact Nvidia a lot. I think the biggest thing that could impact Nvidia in regards to China is for the government to lock down on hyperscaler access, which has Nvidia GPUs in it, to China. Currently, Chinese companies can utilize U.S. and Europe-based hyperscaler infrastructure as a service partners that have GPUs. I do think it would be an upside if Nvidia were to get government approval on this new tuned down version of their latest chips. So I think regardless of what comes out economically on China, if Nvidia gets the green light, it's good news.
Patrick, do you think that the narrative has at all changed surrounding the AI story? Has some of that shine maybe worn off? I'm curious just how you're looking at the development, specifically even really what we've seen over the last 2 or 3 trading days, and just, I guess, put that in better perspective maybe for some of our viewers.
Yeah, so I really see three major buckets for AI plays. The first one is this infrastructure. Anybody who is related to building out these massive data centers with GPUs in them, I think I'm very confident next 12 to 18 months that's going to be the case. And we saw the capital expenditure commitments by Microsoft and Meta and Amazon. It is absolutely pedal to the metal on that. And then there's the longer term downstream, right? The enterprise software providers, that there has to be benefit in a large scale for all this to interconnect, because there is just factually an overinvestment in the capability versus the downstream benefits at this point. And if that gear doesn't connect in, let's say, 12 months, what's going to happen is the investors of these enterprise software companies are going to be asking, where's the benefit, and have super pressure on these companies to start scaling back. And that is when all bets are off. And the final thing I want to add is I still think there's this untapped opportunity, which is the AI PC and AI smartphones. So we saw a little bit on the AI smartphones related to Apple. We saw a slight bump on that. But when you consider there's only one generation of Apple smartphones that can do all the AI tricks out there, and then people are going to have to buy new smartphones, new tablets, and even new Macs. That's really, I think, good news for companies like Apple and Qualcomm and even AMD and Intel.
All right, Patrick Moorhead, always great to get your insight. Thanks so much for joining us here this morning.
Thanks.
Founder and CEO of More Insights and Strategy. Keep right here on Yahoo Finance. We've got much more ahead. Again, just about 24 minutes into the trading day, you still are looking at gains across the major averages. The Dow now up just from the highs of the session, up just over 300 points. We'll be right back.
Welcome back to the Morning Brief, brought to you by Invesco. Now we're taking a look at the biggest market movers on Yahoo Finance. Let's start with Hims and Hers, plus we've got Fubo TV and Celsius. We'll get to that later on, but beginning with Hims and Hers, as we mentioned, shares ticking lower right now. They're down by about 3.5%. The telehealth company raising its full-year guidance, though, and its second quarter revenue beat expectations as consumers seek more personalized treatment plans here. There were a few bright spots within this report, ultimately. I mean, revenue did grow 52% year over year. We are seeing that the net income that came in at about $13.3 million, and then additionally here, just looking at the free cash flow, that's up by about 377% year over year. Oh man, I got the wrap already? Wow. Okay. Just lastly here on this, they are expecting the recent launch of GLP-1 injections to be incremental to a remarkable trajectory, they say, going forward.
All right, let's talk about Fubo TV because shares are on the move following those results. The sports streamer ending its second quarter with 1.4 million subscribers. That's slightly down from the 1.5 million in the first quarter. You're looking at losses of just about 3%. Digging into this report, though, wasn't all bad. Actually, revenue topping the street's expectations. It was actually up nearly 30%, a year-over-year jump of just about 29%. Subscription revenue also up 26% from a year ago. Advertising revenue also increasing. So again, the street taking some issue with these results, but certainly a lot to like within this report.
All right, there are a few earnings reports that I looked at, even when I don't think we're going to cover them, and this one was one of them. Celsius shares in the green after its international segment, and Amazon sales fueled a record-breaking second quarter for the beverage maker. Ultimately, you did see a move higher in revenue. That was up by about 29%. Really, I mean, North America and international growth, 36% there. They also mentioned that they are the leader in the energy drink category here, 47% of all second quarter growth, and they believe that they're well positioned to capture incremental category dollar share. So yeah, I looked at this when we weren't even going to talk about it today. This one in
Look at you, just doing your research.
You got to read all the reports. Why not?
All right, coming up, is the market rebound going to last? Again, all three of the major averages moving to the upside right now. We're going to discuss on catalysts here and whether or not that three-day sell-off could be over. It looks like the three-day sell-off might be over, but what's ahead is really the question. We're going to have more on that next.
It's just after 10 a.m. here in New York City. I'm Madison Mills alongside Shauna Smith. Let's dive into the catalyst moving markets today.
The stocks moving higher with the Dow, S&P 500, and Nasdaq Composite all in the green 30 minutes into the trading day. Now, this comes after a 3-day sell-off, causing the Mag 7 to shed over $650 billion in market cap on Monday alone. We're going to talk to strategists throughout the hour and ask them what changes you should be making to your portfolio.
That's exactly right. We're also going to be talking about what is next for that AI rally. As Shauna mentioned, the Magnificent Seven down 20% from its July 10th highs. We'll talk about whether the sector is a falling knife or a buying opportunity.
Plus, Vice President Kamala Harris reportedly choosing Minnesota Governor Tim Walz as her running mate ahead of the primary elections in Kansas, Michigan, Missouri, and Washington. Well, Harris will take the stage at a rally in Philadelphia tonight, and we are going to be tracking the latest in the 2024 election and break down what it means for your money. Let's kick it off with the big story today, and that is the rebound that we're seeing almost across the board here after recession fears plunged the markets into that 3-day rout. Weaker than expected jobs data pointing to concerns over maybe cracks in the labor market, and that was enough to send jitters throughout global markets. So is that an overreaction, or could we see a steep economic slowdown? For that, we want to bring in Torsten Slok. He's chief economist at Apollo Global Management. Torsten, it's great to have you here. So let me put that question right to you. When you take a look at maybe the market's reaction to that weaker than expected labor data print that we got out on Friday morning, was that a bit of an overreaction? And what are you seeing within the jobs market?
I think that's right, Jana. If you look at, as Jay Powell said last week, the totality of the data, yes, it is correct that the unemployment rate did go up last Friday. And we did see a slightly weaker headline non-farm payrolls at 114,000. But if you look at, in particular, some of the high-frequency data, daily data for how many people fly in airplanes as of last Friday is still strong. Daily data from OpenTable for how many people go to restaurants is still strong. Weekly data for retail sales from Redbook is also still strong. Hotel occupancy rates, the weekly data also still strong. And across the board, there is just not much evidence of the economy either being in a recession or being on its road to entering a recession. So we think that, again, with Jay Powell's emphasis on the totality of the data, that the market is overreacting to just one data point.
Well, it's interesting because, Torsten, it's not just, of course, the labor market. There are several factors that lead to a rout like this, including what we saw with the carry trade and, of course, earnings. I want to point a chart out that you included in one of your recent notes, and it's about the number of AI mentions on earnings calls declining. If this market sell-off that we are seeing right now is in part driven by the unwind that we are currently seeing in the AI rally, does the Fed care? I mean, that seems like a markets issue.
Absolutely. And I do think that for exactly that AI stocks are going down for two reasons. They're partly going down because valuations got so stretched and earnings expectations were simply inconsistent with where valuations were. So when earnings just came in a bit weaker for a few of the Magnificent Seven, the market was reassessing that maybe expectations were too high and maybe expectations were too strong for what these companies could actually deliver. And the second reason why you're seeing the AI stocks going down is because of, exactly as you're highlighting, the carry trade unwinding. You've seen a reversal of a lot of trades where essentially investors were borrowing in yen. Remember, in yen, interest rates up until literally 2 weeks ago, interest rates were zero. Now they went up to 25 basis points. But when you borrow at zero and you invest, first, this trade was going into fixed income. Then it broadened out to buying other asset classes, including AI and stocks, in particular asset classes with momentum. Then you now, of course, with a significant unraveling of the trade, simply because dollar yen has moved from 161 down to 144. That means that if I borrowed in yen, now I need to pay back in yen. If yen is more expensive, that means that I need to pay back more. So that's why it is not only about fundamentals that have been softening for the Magnificent Seven. It's also about the reversal of the carry trade, that a lot of investors who borrowed in yen and used that money to buy, including the Magnificent Seven, are now reversing those trades. So that's why the unwind of the carry trade, it becomes important to discuss how many days, how many weeks will it take before we get to the end of that.
Well, Torsten, you brought up a great point. And then my question is, how ultimately should the Fed then be reading into some of that volatility that we have seen? When you take a look at that 3-day sell-off, clearly the markets have also started to reprice what they think the central bank should do. And I'm taking a look at the Fed Fund futures right now, 75% of traders pricing in a 50 basis point cut at the September meeting. When you take a look at that, is markets simply just pricing in too many cuts at this point?
Yeah, I do think that markets are pricing in too many cuts. It's remarkable what has happened over the last 2 or 3 days. Yesterday, at one point, the market was pricing 6 cuts this year, and now we're back to pricing 4 cuts this year. So that's also telling you that when people say with high confidence, oh, they will cut rates 4 times this year, this is what the market is saying, you should take that with a grain of salt, because just yesterday the market was saying many more, namely 6 cuts. So I do think that when you look again at as Jay Powell has been talking about the totality of the data, and also importantly, Jay Powell last week emphasized that the anecdotes that are coming in are not only negative, the anecdotes are, in his words, more mixed. You still have a number of tailwinds, in particular to higher income consumers, where you're seeing still strong gains from stock prices going up, from home prices going up. And if you own fixed income, including private credit, the cash flows you're getting at the moment are the highest they've been literally in decades. So the consequence of that is that there's still a strong tailwind to the consumer outlook from still, again, relatively elevated stock prices, high home prices, and very importantly, anyone who owns bonds will know that the interest rate payments they're getting at the moment are at the highest level we again have seen in decades. So that's all support for the consumer, and that's all support for exactly the view that we are not seeing the economy spiraling into a recession. Of course, if the stock market does go down for the next several weeks and several months, then of course we will have a different discussion. But given what trading is doing, at least this morning, that's pointing to that let's just wait a few more days before we again talk about this strong likelihood that many people think that we are in a recession at the moment, because I think the data is proving otherwise.
So, Torsten, there still is a number of data points that we were going to get on the economy, on inflation, on jobs here ahead of that September meeting. But I'm curious, what do you think the Fed should do at this point at the September meeting?
Yeah, I think that they should take a deep breath, and so should we in markets, and say, okay, we did get a data point on Friday that was a little bit weaker on the headline. Remember, before last Friday, non-farm payrolls for the previous 3 months was 200,000, for the previous 6 months was 200,000, and for the previous 12 months was 200,000. So 114, it is a little bit weaker. There was some analysis from the San Francisco Fed suggesting that maybe the weather did lower the number. It could have been closer to 150. So suddenly maybe the headline was not as bad as the market is making it. And perhaps most importantly, the unemployment rate did go up last Friday from 4.1 to 4.3. From the outside, that does look like a serious problem. But think about it. The unemployment rate can go up for 2 reasons. Either because people get fired and we have more layoffs, but that's not what we're seeing. The Gray, Challenger, and Christmas survey of job cuts is still very low, very few job cuts. The JOLTS data for job cuts and layoffs is also suggesting that there's not any layoffs, where the whole reason why the unemployment went up is likely because of an increase in labor supply, because of an increase in immigration. And that means that, again, even when it comes to the unemployment increase that we saw, probably also has to be taken with a grain of salt. So that's why, Sheila, to your question, I think that the Fed will be looking at the next employment report next week. This is a relatively light week on data this week here. We do get jobless claims on Thursday, but next week we get CPI and we get retail sales. And that's when the Fed will begin to pay attention again.
Torsten, that's exactly where I wanted to go. Let's say you've calmed our listeners that the labor market, it's not that big of a deal. Do we need to be worried about a resurgence in inflation?
Well, that's at least at this point, of course, now the narrative in markets has absolutely answered that with a resounding no. Now the change has gone to other side of the dual mandate from the Fed, namely worrying more about the labor market. But if inflation continues to come down, if the labor market is still okay, well, that means that, and which is our strong view, that we will get that soft landing. That means that if we get that soft landing, which has now been the path and trajectory now for several quarters, then the conclusion is the Fed can then go relatively slowly with lowering interest rates. There's no need to dramatically cut interest rates because there is no dramatic slowdown in the economy.
Really quick, Torsten, final 30 seconds. When then do you expect to declare that we have had a soft landing?
Yeah, so I would actually already say that we have had a soft landing, but what really did throw a little bit of a wrench into the soft landing was indeed the data last Friday. So that's why the discussion in markets should be, is the data last Friday on the employment side and unemployment, is that the beginning of a new trend? Or was it really just a statistical quirk? And now we'll get data that shows, like we got ISM services yesterday, that things are actually not that bad. So that's why the next several weeks it will become very important whether we still see soft landing or whether the data confirms that narrative that the market is so worried about, namely that harder landing.
All right, Torsten, can't thank you enough for coming on and walking our viewers through this confusing time. We really appreciate it.
My pleasure.
That was Torsten Slok. He's the chief economist at Apollo Global Management. We should also note that Apollo is Yahoo Finance's parent company. Moving forward here, stocks looking to recover today after those losses on Thursday, Friday, and Monday, that 3-day rout. But is it too early to declare that today is a turnaround Tuesday? Here to talk about why he may be staying on the sidelines for now, we've got Chris Watling. He is the CEO and Chief Market Strategist of Longview Economics. Chris, thanks for coming in here. So, yeah, I mean, turnaround Tuesdays, they can sometimes feel like we're off to a good start and then not last throughout the day. What do you think?
Well, it may well last throughout the day. I think what one has to remember is sell-offs tend to happen in waves. So it's not just a straight line down, then we're done. You know, there tend to be 3 waves or 5 waves, and in the middle of that, you get these relief rallies. So it's perfectly natural that you have a very aggressive downside, a little bit of short covering, which creates a rally, which is probably what we're in now. If I look at our sort of market timing, fear and greed models, the market's pretty fearful. It may get a tiny bit more in the short term. So I wouldn't be surprised if you get a wave 2 relief rally, a bounce. But don't get suckered in by it is the point. I think that's the key here.
What do you think this signals then about more so, not so much over the next several trading days, but the longer term? Should at all investors be a bit encouraged maybe by some of that buying action that we are seeing here at the open?
Well, what do we think of the? Well, I think the most important thing that's happened in the last few months is not what's happened in the last few days. It's what happened on July the 11th. When we had US CPI out, and it came in softer than people expected. Right. And you remember the market rotated aggressively, and the Nasdaq sold off hard, and the Russell 2000 and cyclical stuff around the world went up. That is a real marker day, because that is telling you, I think we're in a phase of global sector rotation. So the leadership of the stock market globally is changing. So now we're in a liquidation event. Most global sector rotations turn into sell-offs. You never change global sector leadership without a big pullback. So we're doing that. And the trick is to use this next few weeks, couple of months, as an opportunity to get into the new sector leadership. So I would suggest the AI, the Mag 7 leadership's done, finished. I could be wrong. It's a big call. I accept that. Well, you know, I remember coming on here. I was last in New York in April, and I came on, and I remember saying at the time, every man and his dog owned Nvidia. And there we go. We've just had the proof. You know, the quick selling. The point is, markets have fashions. They last for a long time. They end up with everyone owning the thing that's the fashion. And so it's all priced in. It was an expensive sector, over-owned, et cetera, et cetera. Now the psychology is potentially changing. It's kind of interesting as well, because if you listen to people over the last month, they're sort of questioning AI. No one's saying it's not going to be great, but it might just take longer. It might just cost a bit more, et cetera, et cetera. So that's kind of interesting as well. So I kind of feel, and on top of that, I think the important thing about July the 11th is it embedded in markets the idea that we're going to get a Fed rate cutting cycle. And this softer data last week in the US reinforces that. So yes, we're in a liquidation event. The Japan stuff's critical. But really, we're in a global sector rotation, and over the next couple of months, that's the way to play this thing. If you're looking at a couple of years, basically.
I got to do one more on the Nvidia of it all. We just had an Nvidia chart year to date up showing the gains over 100%, even with the recent sell-off that we have seen over the past couple of days. I believe it says up over 110% year to date. So, Chris, particularly as we head into Nvidia earnings in a couple of weeks here, how big of a risk is that to your call?
Well, I have no idea what their earnings are going to say. I'm a macro guy and a strategist, but my guess is that a lot of the good news is in the price, from the way the stock's trading, from all the psychology, from the over-ownership. And yeah, I don't know. I don't know what's going to happen on earnings.
Okay, so then I think the question in all of our family group chats, right, I'm sure you're experiencing this as well, is just what do we do right now? What do we do with this pullback? What are you telling people in your family?
If you're, well, I wouldn't. My parents are too old to trade markets. I tell them to buy the bounce, trade them for a couple of weeks, go long, if you're nimble. But really lighten up if you're a sort of multi-month investor. It all depends on your timeframes. That's the challenge. So we think about markets on lots of different timeframes, which generally confuses everyone.
All right, well, great advice. Thanks so much for helping us out here at what is a very confusing time for a lot of investors at home trying to figure out what moves to make in their portfolio. Chris Watling, always great to have you. Thanks so much for joining us here in studio. CEO and Chief Market Strategist at Longview Economics. We'll keep right here on Yahoo Finance. Coming up on Catalyst, Lucid shares moving higher, looking at a gain of just about 3.5% after a $1.5 billion cash infusion from a top shareholder. We're going to have those details when we come back. Lucid shares are up just about 2.8%, nearly 3% move to the upside after announcing its largest shareholder, Saudi Arabia's public investment fund, will give the firm an additional $1.5 billion in funding. Now, this coming as the company gets set to launch its new electric vehicle. Lots of questions about what ultimately the future of Lucid looks like. So again, the fact that they did get this cash infusion, obviously, this is going to extend the timeline here. Citi's out estimating that the new $1.5 billion capital raise is expected to extend Lucid's liquidity runway all the way to the fourth quarter of 2025. It also went on to say it's going to help Lucid here navigate what has been clearly a global slowdown when it comes to EV demand, also the launch of its mass market SUV. And remember that this funding comes on top of a $1 billion injection back in March and raises the total that the Saudi Aramco fund has invested into approximately $8 billion. So again, Lucid shares moving to the upside. They are off their highs of the morning, but again, the street obviously viewing this as a positive here for the stock.
Yeah, it's interesting because last quarter there were concerns about liquidity with Lucid. And of course, today that's not a concern given this $1.5 billion cash infusion that they are getting from the Saudis. The big question I'm going to have is what the executive team is going to be doing with that infusion of liquidity and whether or not they're going to be able to utilize it to continue to reach further gains, particularly with investments in the SUV EV and what that's going to look like in terms of the ROI on that moving forward. Obviously, the street is thinking that $1.5 billion in funding is going to be a positive catalyst for the stock moving forward. Again, the announcement from the Public Investment Fund of Saudi Arabia is committed to providing what they say, quote, is sufficient liquidity into at least the full fourth quarter of 2025. So certainly a little bit of runway to come for that infusion of cash.
All right, let's take a look at Yum Brands because they've reported a mixed results here after earnings topped expectations, but second quarter revenue fell short. The company reported same-store sales declines at KFC and Pizza Hut. They also cited geopolitical challenges and a, quote, more cost-conscious consumer. And they also went on to say that the impacts from the Middle East conflict, in addition to the more cost-conscious consumer, has presented those headwinds to same-store sales. I do want to call out, though, that what seems to be helping or maybe alleviating some of that stress that we have seen on Yum Brands has been their value meals. They went on to say that Pizza Hut's $7 deal lovers, I didn't even know they had this, has been helping their sales trends, at least here in the U.S. compared to the prior quarter. So they are seeing a bit of a shift there in terms of a more positive direction there. Obviously, we know a lot of consumers are on the hunt for value, especially at a time when inflation still remains a constant issue with millions of consumers. But Taco Bell reported same-store sales growth still remains the standout here within this print, Maddie.
I thought it was fascinating, the things that the chief executives and the folks on the call were talking about, specifically with regards to geopolitical tensions fueling some losses. Immediately at the top, they were talking about tensions in the Middle East and the impact that was having, particularly on same-store sales. That was the case for Pizza Hut and KFC, as you mentioned, Shauna. But also, this is just the latest example of a brand that is struggling because of consumer consciousness. You mentioned the value meal offering, that was not enough for this quarter, at least not the value meal offering, but the $7 meal that I also hadn't heard of. I shouldn't brand it as the value meal because that's obviously a competing retailer's name. Having said that, though, it's interesting to see these brands continuing to somewhat lose their ability to have pricing power in the face of consumers that are struggling under the weight of inflation. Lowering prices, if that's not enough to get consumers in the door, then really what will be the answer to that question as consumers are trading down to groceries for their foods? What is that going to look like moving forward, particularly as we are getting an environment where their labor market is starting to have some issues? Could that lead to further issues with consumers moving forward? That'll be a big question, of course, as we get inflation data coming in the next couple of weeks. All right, well, another big story, of course, we are watching this morning. Google facing a huge loss after a judge ruling its search and ad businesses violated antitrust law. Alphabet stock down a little over 1% this morning. The big question, could this actually have a major impact on another tech giant? Yahoo Finance's Dan Halley is here on set with us with the details. So, Dan, obviously the big question here, Apple. What's next?
Yeah. So part of this whole case going to trial and some of the details that came out was the Internet Services Agreement between Google and Apple. And essentially what that means is that Apple is able to or required to use Google as its default search engine in Safari, in Siri, in Spotlight search. And so whenever you do a search through any of those services, you're going to be using Google's platform. Now, what does that mean for Google? Well, it means that it gets a ton of traffic driven its way. According to these court documents, Google did internal modeling in 2020 and found that without Apple, it would lose, without that deal with Apple, it would lose 60% to 80% of search volume on Apple's iOS devices. So if you removed Google as the default, it's losing all of that traffic. And a lot of people just pull up their phone and do Spotlight search or pull up their phone and search in Safari. And so that's where it's getting that. That would equate to, let's see here, $28 to $32 billion for Google's bottom line. That's 15 to 17% of the company's total revenue in 2020. That search volume is driving. Now, on Apple's side of things, yes, it's getting a good product, but it also gets $20 billion a year for using that as the default. Now, what does that go into? Well, likely it goes into its services business. They don't really say where it goes. Right. Apple is just like, oh, we got third-party agreements. that's a third-party agreement. So it's probably in its services business. In 2022, Apple saw $78.1 billion in services revenue. That $20 billion then equates to about 25% of services revenue for the year. It's not obviously a massive chunk for Apple overall. It's 5% of the annual revenue, but still a sizable piece of the overall pie for Apple generally. And so, if all of this goes forward, if they manage to or don't manage to win any appeal, if these agreements are kind of null and void, we'll have to see where this goes. Apple risks losing a ton of money. Google risks losing a ton of money. I think the big question is, do you want to use Bing? Do you want to use Yahoo? No offense. Do you want to use DuckDuckGo, or do you want to stick with Google? And I think for a lot of people, they'll probably stick with Google at this point. And so, all of this is kind of an interesting discussion because according to the judge, they are in violation of antitrust laws. I use different products all the time, and I still go back to Google. So it's difficult because are they so good because of this, or are they just good? And so people are going to still stick with them.
It's interesting. And I also just think trying to figure out how big of an overhang this is ultimately going to be in a stock, or when you put it in context, yes, it does equate to obviously billions and millions of dollars potentially of lost business, or exactly what that's going to mean. But it seems like a drop in the bucket then, just given the massive size, obviously, and influence that Google and both Apple have on the market at this point.
I mean, for Apple, I mean, it's, I think the important thing to point out is that services is its fastest growing business, right? That services is seen as kind of the backstop that helps Apple when it comes to flagging iPhone sales. For years, that's been the narrative, right? They're building out services as a bulwark against falling iPhone sales. That's why they got Apple TV Plus, Apple Music Plus, all these different services, and $20 billion from Google a year, right? So I think that's a potential issue for them, just because it kind of hurts that narrative to a large degree, that 25% of overall services revenue for 2022. It's a huge issue. For Google, losing all that search volume is going to be a problem from iOS.
And it seems like it's too late now, potentially, for Apple to say, oh, well, we'll just invest in our own search engine. It seems like maybe the boat has passed on
Apparently, they, according to these court documents, they had gone into looking at that, and it would just be too much money for them to do. Yeah,
too much money even for Apple. It's amazing, folks. All right, well, thank you, Dan. Really appreciate you coming on set and bringing us that story. Coming up here, cryptocurrency. We are seeing a little bit of a reversal here, particularly in Bitcoin, that is up 6% today. What does it mean for your asset classes and your investments in the alt asset? We're going to discuss exactly that when we come back. let's take a look at cryptocurrency, specifically Bitcoin, moving to the upside here, up nearly 7%. This comes after the record-breaking sell-off that we saw, leaving Bitcoin below $50,000 on Monday for the first time since February. Joining us to discuss what is next for Bitcoin, we've got our very own expert, Jared Blickery. Jared, what do investors need to know?
Bitcoin is mounting a nice comeback. This is the best day for Bitcoin in about 3 weeks. You could put Ethereum in the same bucket there, but that is after the worst day in several years. That was also the case for the stock market yesterday. So this is what we're seeing. Bitcoin up about 7% over the trailing 24 hours. So is Ethereum. But when I put a 3-day view here, you can see Bitcoin down about 3%, Ethereum down 5%. So still haven't clawed back all those losses. Let me show you too from a 3-day view. This is actually, the price has just rallied into an area which is going to get shorts interested again. So the big test here is, can Bitcoin get above 60,000? And I'm going to show you a longer term chart. This is a 5-year chart. 60,000 is just this line that has been important historically. And you can see here, we are just in the midst of a little flag. You could call that a bull flag. But nevertheless, on a year-to-date chart, you can see we've been making lower highs and lower lows. So that is a definition of a downtrend. The question is, when does it reverse, and do you have a washout before that happened? And arguably, we might have had the washout already. You look at the candlestick action that we had yesterday, that was a big test of the 50,000 area, which was strongly rejected to the upside. So all in all, I was looking at fund flows too with the new Bitcoin ETFs and new Ethereum ETFs. The Bitcoin ETF dip buyers were absent yesterday. However, the Ethereum buyers, dip buyers, they were out in full force, and so kind of a mix there. You look at the 3-day price action in all of these tokens here. You only see a few outperformers. It is interesting to me and actually important that we do see some of the fringe tokens like Dogecoin participate here. Doge is up 7%, but even Solana up 13%. So we'll see if anything mounts of this comeback and perhaps false washout to the downside.
All right, Jared, thanks so much for breaking that down for us here. We're going to take a look at crude and Saudi Aramco because shares are rising after its second quarter net income met expectations. The oil giant maintained its quarterly dividend. We're looking at gains of just about 1.5%. Ines Ferre has been closely tracking this. Ines, what can you tell us?
Yeah, Shauna, and that quarterly dividend that has been maintained, part of the reason why that stock is up right now, because Saudi Aramco said that it will maintain its $31 billion in dividend for the second quarter. That includes about $20 billion in dividends, but also you have another 10 that is performance-based, with Citi analysts saying that the firm has enough financial flexibility to fund the payout. And this is despite lower profits for the second quarter, or a profit decline for the second quarter. That's because in part of production volume that's down, and also because of the lower margins, refining margins, that during the conference call, management referred to those weak refining margins, saying that that's a short-term phenomenon, that they expect that in the coming decade, they'll be healthy again. Now, when you compare Saudi Aramco to the stock performance to other oil companies, if you take a look at ExxonMobil, for example, or Chevron, ExxonMobil is up around 11% year to date. Chevron's down about 3% year to date. Aramco is down roughly 17% year to date. It's important to keep in mind that Saudi Arabia has undergone those voluntary output cuts. So you're looking at about 9 million barrels per day. That's the lowest level in 3 years. And Saudi Aramco was able to sell its oil at around $87 or just below $87 per barrel last quarter. That's compared to $78 per barrel in the prior year, for the same quarter in the prior year. Now, when it comes to the oil prices that we've seen recently, Aramco CEO Amin Nasser said during the earnings call that the market is overreacting to the dip that we have seen in oil prices, that it's reading too much into the short-term responses of the news coming from the U.S. with regards to the number of jobs for the month, referring to that jobs report that came out last Friday. Shauna?
All right, Ines, thank you so much for joining us on All Things Saudi Aramco earnings. Really appreciate it. Now, coming up, the big question, is the AI rally really over? We're going to unpack what is next for the big tech trade coming up next. Let's zero in on the Magnificent Seven because the basket of tech stocks lost $652 billion in market cap just on Monday alone. But we are seeing a little bit of recovery here. If you take a look at Nvidia on your screen, that is up nearly 4.5% on the day. Microsoft shares up over 2% and Meta trading to the upside as well. But the big question, what is next for the big tech names that have driven the market to over 35 all-time highs this year prior to the recent rout? Joining us to discuss that, we've got Maxwell Grinikoff, the U.S. equity derivative strategist at UBS Investment Bank. Maxwell, it's great to have you. So in your note, you mentioned that the AI narrative and real yields remain the largest drivers of returns. Can investors still continue to kind of rest on their laurels of the AI trade moving forward for the second half of this year, given what we've seen over the past few days?
Yeah, thanks for having me. So look, what we've been telling clients is the sort of initial move in volatility on Friday was definitely warranted, and it was really a story of everything everywhere sort of all at once. So as you allude to, from a fundamental standpoint, in addition to the AI tailwind concerns that you had from a lot of the sort of major tech bellwethers through earnings, you also had growth slowdown fears creeping back up when it comes to the macroeconomy. You also had geopolitical and U.S. Election risks rising, right? Obviously, a lot of sort of technical risks that also led to the VIX spike on Friday and yesterday. But I think moving forward, we do want to actually have a sort of long quality bias, and think there's sort of low quality pockets like small caps relative to large cap growth in tech could actually continue to underperform in the near term.
Maxwell, as we're trying to figure out just where we are within the midst of this sell-off, we are seeing some of that buying activity today. Something stuck out to me in your note, and it was the early warning signal that you had been flagging, a higher probability of a more than 5% absolute move here over the next month. I'm curious, have you seen an update to that following the last 3 days? And I guess what is that then signaling to you now?
Yeah, so the great thing about this model in particular is it doesn't tell us when it's raining, it tells it is likely going to rain. So over the last couple of weeks, we had actually started to see that move downwards in terms of telling us or flagging to us that we were going to have a higher probability of a plus or minus 5% move over the next 1 month. We obviously clearly got that, over the last, couple of trading sessions. But the biggest driver in that particular output that we flagged was actually Fed policy expectations, post FOMC in particular. Now, something to note, and the real common denominator here is that when that model in particular looks back to history, typically when you move into a Fed cut cycle, it's usually accompanied by a recession, several months after. So that R word, as I noted, right, that's going to be key over the coming weeks and months in terms of the data coming through. CPI next week, Jackson Hole at the end of the month, September FOMC obviously next month, right? This data is going to continue to be very pertinent in terms of sort of what that model is going to tell us going forward.
So how should investors be positioning ahead of an anticipated rate cut come September?
Yeah, so it's interesting, right? And this was sort of, flagged as a sort of not so ugly when we considered the good, the bad, and the ugly, when it came to the moves over the last couple of days. And typically what you've seen historically is you've seen volatility or the VIX rise into Fed rate cut cycles historically and retrace thereafter, unless, again, accompanied by recession. So right here, right now, right, and we're already starting to see this play out, we do think volatility ultimately fades a little bit from here unless the data really continues to sour. That is, bad is really bad and the Fed is behind the curve, whatever it may be, right? But we do think it's going to take a few weeks to do so, and our models are suggesting that again the data is going to be very pertinent over the next couple weeks in terms of kind of continuing to see a retracement back to normal. But we also don't think we're getting back to a VIX at 12 environment, for example.
I want to end on the VIX since you bring it up. We saw it basically tripling overnight here, but we didn't see a lot of stocks hitting 52-week lows, especially as we opened up this morning. Given that kind of divergence, what opportunity does that spell for investors in picking maybe specific stock names?
Yeah, and that goes back to kind of what I alluded to before. You know, the move yesterday was clearly dislocated from reality, right? We do think there was a lot of technical factors in the VIX relative to, you know, the S&P 500 index or the Nasdaq or the Russell 2000. You know, you did have investors sort of rush to buy downside protection post NFPs, post Bank of Japan, which we had noted for several months that investors had not been doing. So investors were much less defensively positioned than they had been previously. So that's why we think you saw, you know, the largest intraday VIX spike in history next to Black Monday in 1987, right? But also the sort of largest intraday retracement in history, as a lot of those sort of hedges that were put on were monetized. Keep in mind, the S&P was only down 3%. We've obviously had larger moves, you know, in history. When you look at the analogs, you know, 1987 down 20%. You know, March 2020, you had some down 5, down 10% days, right? So the reactivity in the VIX relative to the S&P move or other major indices was clearly dislocated from reality. And we do think there's room for normalization, and we're obviously seeing that in the price action today, with investors using this as a sort of buy the dip opportunity.
All right, Maxwell Grinikoff, great to have you here. Thanks so much for joining us. U.S. equity derivatives strategist at UBS Investment Bank. Thank you.
Thanks.
Keep right here on Catalyst. Again, taking a look at the major averages, just about an hour and 15 minutes into the trading day. You're looking at the Dow right around the highs of the session, up just about 440 basis points. You have the S&P up about 1.5%. The Nasdaq also reversing yesterday's downward move. You're looking at gains just about 1.3%. We'll be right back. Vice President Harris has selected her running mate, Minnesota Governor Tim Walz. Now, the two are expected to appear together later today at a campaign rally in Philadelphia. For more on this selection, we want to bring in Yahoo Finance's Rick Newman. Hey, Rick.
Hey, guys. I didn't see this one coming. I thought Mark Kelly, the senator from Arizona, on paper seemed like the best fit, but Kamala Harris decided otherwise. Tim Walz is his career before he became a politician was a teacher. He spent 24 years in the Army National Guard. Progressives like him and independents like him too. So he's a sort of a plain-spoken, affable, friendly Midwestern guy who's going to complement the ticket with a California former senator and current vice president.
Rick, I'm curious too, moving forward here, what you think the reaction is going to be. We've already heard, for example, J.D. Vance responding about the decision to not pick Shapiro. What do you think the Trump campaign is going to do in terms of strategizing around this pick?
Well, I mean, the whole strategy of the Trump campaign toward the Harris campaign is try to find all their vulnerabilities and hammer them home. I don't think that any criticism of who Kamala Harris picked or did not pick is going to last for very long. I mean, what J.D. Vance is trying to say is Josh Shapiro, the governor of Pennsylvania, he's Jewish and he's staunchly pro-Israel. So the Trump campaign is trying to say, oh, they're afraid to pick some guy who is a heavy supporter of Israel in its war against Hamas and all its other enemies in the Middle East. Therefore, I guess Jews should vote for Trump Vance. I just don't think that's going anywhere. I mean, I think that's a Today story and it's going to just drift away. I mean, the Veep stakes is kind of fun while it's happening. And then when it's over, the vice presidential nominee just doesn't matter very much unless it's somebody who generates negative press for you the way Sarah Palin did for John McCain in 2008. I clearly think that Tim Walz is not going to be that kind of guy. You would assume they vetted him to find out if he had any childless cat lady type videos in his past, anything controversial he said that could dog him. J.D. Vance on the other side, he's more controversial, so we'll see if he ends up being a net negative for Trump. But just as a way to kind of hint at how important vice presidential candidates are, just ask you guys, I'm not going to put you guys on the spot, but I'm going to ask you guys in the audience, does anybody even remember who Hillary Clinton's vice presidential pick was in 2016? Pause for effect. It was Tim Kaine, senator from Virginia, another sort of affable, soft-spoken guy. And I think a lot of people probably don't even remember who he was. So that, the Veep stakes is over, and now we get into Harris versus Trump.
Well, Rick, you have to remember that because remember the guy who always buys the website URLs for every possible presidential candidate, and he had the Clinton Kaine URL. He got to sell and make a lot of money. He also had Harris Waltz, so we're going to have to check in with him later, Rick. But thank you so much, as always, for joining us. Really appreciate you.
See you guys.
Thank you. Now, the big question following Kamala Harris's VP announcement, how could the final ticket impact her support, particularly within the business community? Here to discuss this, we've got Leslie Feinzag. She's the founder of VCs for Kamala joining us. And Leslie, thank you for making the time. I want to start on the reaction that you are hearing from the folks who signed this letter published by your organization supporting Vice President Kamala Harris's run for president. What are you hearing from folks in the VC and tech community about her VP pick this morning?
Very little, because I've spent most of the morning putting my kids out to have breakfast and preparing to speak to you guys. But I think that over the past few days, she had really, really good choices to pick from. And the first tweet that I saw this morning was that we're about to get a Minnesota nice vice president in the administration. So I'm really excited to learn more about the future vice president.
Leslie, talk to us a little bit more just about why or how critical is this election for the tech industry, and why is Kamala a better pick for tech than former President Donald Trump?
Yeah, this is a critical election for the business community and for the country at large as well. And I think, I have been saying this a lot lately, and I do realize that it is not the sexiest talking point, but we need stability to have prosperity. Any business owner, anybody who has ever tried to launch a business, launch a startup, knows how hard it is to launch and grow a company, how hard it is to make payroll month after month after month. And the founders that we invest in as venture capitalists that are not only trying to start companies, they're trying to scale them to be the next public companies of tomorrow. That is an extraordinarily hard thing to do. Now, try doing that under an erratic government with inflationary policies that's picking a trade war with China. You wake up one day, you don't know what else is going to happen. It just makes it really, really, really hard. So we can't have an innovation economy that is taking big steps and big risks if we have a government that we can't rely and count on. So that is the big message that the business community feels. But I think on top of that, Kamala Harris has shown an openness to the business community, especially the tech sector. She's been working across the aisle on the CHIPS Act. She's been wanting to bring innovation home. And this campaign is a pretty new campaign, right? It's only a couple of weeks old, but already it feels like her agenda is about creating growth and opportunity for the middle class. And that is what all of us want.
Leslie, do you think that's a shift to them? Because I was going to say she hasn't necessarily gone easy on the tech industry. When you take a look at what she's done in the past, she's supported laws on digital privacy, online harassment, gig worker protections. Are you confident, I guess, in what you heard, or maybe some of the conversations that you're having with your colleagues there, that a Harris presidency will look a lot different maybe than some of her approaches and how she's dealt with the industry in the past?
So listen, when we are dealing with technological innovation that is going to shift the future for every single person, not just the people running it, but every user out there, every family. I think we do need a government that works collaboratively with the tech industry to create sensible legislation. And I feel like the first thing you need to do that is to be technologically savvy. So, I think age is a major factor here. The fact that she is a Bay Area native and has deep connections to Silicon Valley, she appears to be listening. She is taking a better stance around M&A activity. And, we have her ear, and we believe that this is a leader that we can collaborate with.
What do you mean by we have her ear, Leslie? Have you spoken with Harris yourself?
I really, really wish I had, but no, I have not. But I think, I don't know that ordinary everyday people understand the venture capital community. We're not necessarily known for being activists. We're not really known for being terribly collaborative necessarily. So the fact that you get 700 venture capital investors, these are the people that are picking the titans of tomorrow to agree on one sliver of an idea. And that is that this is the president that we want for this next election. Now, this is not a political coalition, right? We are a very broad variety of voices from every part of the political spectrum that have signed into this pledge, and it does not represent where in the political spectrum they are. What it is in this election, we believe that this is the future of the country that we want to see.
All right, Leslie Feinstein, we have to leave it there. Thanks so much for joining us here this morning. Founder of VCs for Kamala. Thanks, Leslie.
Thank you for having me.
Let's do a final check of the markets because we're seeing a bit of a rally here just about 90 minutes into the trading day. You're looking at gains across the board. You've got the Dow up just shy of 500 points. You've got the S&P up about 1.6% as well as the Nasdaq. Keep right here on Yahoo Finance. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith, he has you for the next hour. Stay tuned. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, stocks are coming off a big two-day sell-off. We'll talk about investing during down days and explore the psychology of money during those downturns. And according to Redfin data, a quarter of Gen Z house hunters, they're willing to sacrifice safety to afford a home. We'll dig into the data with the firm's chief economist. Plus, it's early August and time to start thinking about sending the kids off to school, or maybe you're going back yourself. We're going to talk about financial literacy, education in the classroom and at home. We've got all that and much more, but let's start here. Stocks rallying today, coming off of a big two-day sell-off here. That move to the downside Monday may be causing some hurt for investors, seeing that line in your brokerage account tick a little bit lower. So let's talk about it with Jeremy Bryan, Gradient Investments Senior Portfolio Manager. Jeremy, great to have you here with us. I mean, first of all, let's put this in context. It was slippage, but we haven't erased all of the gains. So what were you telling clients over the past couple of trading days here?
That's exactly right. Context is important here. We did have, anytime these types of activities happen, and especially when they happen at an accelerated pace like we saw here recently, you have to kind of pull yourself back and give yourself a little context. Is that the market, even after this correction, is still up over 9%. That's in line with long-term averages. And secondarily, since the end of last September, we're up nearly 30% during that time. So, I think people generally and should absolutely have questions, concerns, try to understand what's going on, but also take it under the assumption that we've had a really strong rally here and that corrections happen quite frequently. It's usually the abnormal part is that 30% that we don't experience a correction, right? So volatility is a natural part of the overall stock market. It's a natural part of investing. It happens quite frequently. You usually just have to kind of weather the storm, and you usually end up more prosperous on the other end of it.
What is a good rule of thumb or even tips for how to invest amid a downturn?
Right. I think the biggest thing is understand your level of risk and what you're trying to accomplish. When you see big rallies like we've seen over the past 6, 8, 9 months, a lot of people can get away from what their natural investment plan is and start to chase returns because everything looks like it's going up, right? You see the neighbor, you hear the neighbor getting rich and all of that stuff, and you start to do things that are absent and away from your investment plan. I think when you have things like this, it's a natural component to obviously be concerned, but secondarily to just take a breath and understand where you are from a risk objective and does it fit with your overall plan and what you're trying to do with your money.
Absolutely. And so for the stocks that perhaps, even if there are some risky assets out there, as we've been talking with analysts and strategists over the course of this morning, they've been giving us where they line up on where to perhaps bite into some risk right now at discounted prices and where to still kind of stay on the sidelines. How are you evaluating that?
Yeah, it's a fantastic question because I don't think generally stocks are what I would call in the bargain bin yet, right? Is that we've been quite expensive, to be honest with you, in the markets. Markets are above their 5 and 10-year average valuations. So it's not like this correction has created an ultra cheap market, right? So really you do have to kind of pick and choose your battles, and you have to understand where you think opportunity is. And I think that under two thoughts here is that one, where is growth going to continue in that space? If the market does slow down or the economy does slow down a little bit, who are the companies that can continue to grow during that environment? And what am I paying for those companies? And I think that's where you can find some things in the bargain area. Is a company that really fits that to us is something like Cigna, right? Which is a massive health insurer. They're going to continue to grow probably this year and next year quite well. And the stock is at a near 10 times, next 12 months earnings multiple. That's a pretty cheap stock. Those are the kinds of bargains that we're looking for on our side and saying, what can we use as this temporary dislocation to take advantage of because we still think the company is in a healthy spot, and now we're paying a much cheaper valuation to where we could get upside going forward.
And on the other side of that, are there names that you wouldn't be touching with a 10-foot pole, regardless of a bargain bin level?
The only thing I would say be cautious on is something that's had, a 5 and even 10% correction, but it has rallied 130% over the last 9 months. Just because it's had a little bit of a correction here doesn't mean that it's an automatic buy. Is that, especially companies that have had material changes in their growth profile going forward, that's where we would be most cautious in saying, it's corrected here 10%. Well, if the valuation is still excessively high, it's just not quite as high as it was before, and also the growth profile is having some difficulties, those are areas where I would still say, where you're trying to avoid the falling knife is that transition from growth to value, which can be quite painful and usually lasts a lot longer than people anticipate. Those are the kinds of areas that we would just be a little bit more cautious on right now. So again, just understanding what you're owning, understanding we came from a very expensive market, and that even this correction, some of those stocks still might be quite expensive compared to what their growth looks like. Jeremy Bryan, who is the Gradient Investment Senior Portfolio Manager. Jeremy, thanks so much for kicking off the show with us. Appreciate it. Thank you. Certainly. Let's shift gears to the housing market here. Housing affordability challenges are showing up more and more in the data here. A new Redfin survey finds nearly 1 in 5 house hunters are willing to sacrifice their physical safety to find a home that they can afford. Here with more on the report, we've got Daryl Fairweather, who is the chief economist over at Redfin. Daryl, great to see you here with us. Take us into what we're finding in this kind of result, because it's interesting where there is, whether it's the proneness in one area to experience more hurricanes or, other factors that buyers are willing to say, you know what, we're going to take on that risk. Maybe we'll just purchase better home insurance, but this is the house that we've settled on and that's what we're comfortable with.
Yeah, I think that one of the more surprising things in the survey was that concern about crime was in the top 5. It was actually tied with being close to family as a reason that people were moving, which is not something I would have expected. The normal reasons people move are related to affordability or wanting more space. Climate is a bit lower down on the list. I was surprised to see safety and crime so high up. Interesting. Also within this, 1 in 4 house hunters willing to trade off access to quality schools. What do you think was kind of playing into that result? I think it just comes down to affordability. Neighborhoods that have high quality schools, the homes tend to be more expensive. And especially for people who have really young children who aren't able to go to those schools yet or who don't have children at all, trading that off is an easy way to save on the price of the home. Was there any noticeable difference across the generations that were surveyed here? I mean, we're like, as we're thinking about so many of the new home buyers that are just trying to get into the market right now, a lot of Gen Zers, a lot of millennials. Well, young people, they were some of the most willing to make sacrifices, whether that be being in an area that has more crime or being in an area that has fewer restaurants or fewer amenities. And I think that comes down to, well, they're going to get whatever they can afford. It was really difficult. It's been really difficult to break into the housing market because there's such low inventory. So home buyers overall are just having to figure out what can they get that's within their budget, given what's available on the market. There have been a few reports, and I mean, your team puts out so much data. It's amazing to even try to track it on a day in, day out basis. But there was another report that was published talking about the thousands more people moving in than out of some of the fire and flood prone America, fueled by migration to Texas and Florida. I wonder what you're seeing in the thought process around those home buyers and those who are migrating as well. Yes, during the pandemic, when the mortgage rates were low, a ton of people moved into the Sun Belt, primarily Texas and Florida and Arizona. And there's been a lot of building there, too. A lot of developers got into the market. That's why we've seen a bit of a price correction in places like Austin. In Florida and Houston, though, we're seeing softness in terms of prices more because of how much maintenance costs have gone up and HOA costs and insurance costs. All of those are related to inflation, but they're also related to the frequency of natural disasters, which, the climate overall plays a huge role in that. So we've seen some softness in Florida. We're tracking whether that's going to continue going forward. I know that, hurricane season is upon us. So we'll see how the frequency of disasters impacts people's willingness to live in those areas.
Yeah, and we've been keeping tabs of those billion-dollar disasters as tracked by NOAA as well here. What should people remember about insurance and their coverage and the protections that they're getting if they are moving into some of those areas?
Well, insurance costs can vary widely depending on where you're buying a home, because the insurer is taking into account how prone that home is to a disaster that would require an insurance claim. That could be wind, it could be hail, it could be hurricane. Flood is usually a different type of insurance. So if your area is in a flood-prone place, you should look into flood insurance as something that's supplemental. There's also a national flood insurance program. One thing just keep in mind is that just because you get a certain quote today does not mean that's the quote you're going to get moving into the future. Insurers can raise costs on you, or they can pull out of states, as we've seen in California and Florida. So I think people should just be ready to pay more in insurance moving forward.
Daryl, great reminders there. Great to see you, and thanks so much for the insights. Daryl Fairweather, who is the Redfin chief economist.
Thank you.
Coming up, everyone, we've got the CEO of Tanger here, Stephen Yalof, who is going to discuss the state of the consumer and give us some insights into how their company is doing as well. That's right after the break. Stick with us. Despite the rise of Shein, Amazon, and all the other online-only retailers, 97% of Gen Z shop at brick-and-mortar stores, according to the International Council of Shopping Centers. And Tanger is seeing that reflected in its second quarter earnings report. To discuss what the report says about the state of the consumer, we've got Stephen Yalof, who is the Tanger CEO, joining us here in studio. Great to see you once again.
Thanks for having me back.
Absolutely. Okay, so what are we seeing in the pulse of the consumer right now? We've got continued economic data readings that are showing that there is a battle-weary consumer right now, as the Conference Board Chief Economist Dana Peterson told us. So where are you seeing strength versus some pockets of weakness that the consumer is weathering through?
Well, first of all, that middle pocket of price point is really attractive to the consumer right now. So embedded in that category, we see a lot of the family apparel. Mm-hmm. So you were talking about the Gen Z consumer. That consumer is buying, they're going back to the Gap. They're buying Banana Republic, Old Navy, J. Crew, brands like that. And those are the brands that we see popping in our space. Mm-hmm. Higher price point items right now, they're not having the same sort of day that these particular brands are. And then we talked about Nike, and Nike, had a few consecutive quarters of struggle, coming back in our space now in a big way. So it's interesting to see the evolution of the brands, in a very inflationary time.
Right.
Price deflation, particularly in the outlets, mm-hmm. where prices, you get great value all day, is very attractive to that consumer.
This is a time of mass digital investment for these brands. How do you go to these brands and say you still need to be in brick and mortar, and what's the response from them?
I think that the consumer likes the idea of window shopping online, but actually making their purchases in the store, particularly in the apparel categories and the footwear categories. There's commodity that you can buy online for sure and reorder. But a lot of that, when you make a decision to buy a suit, you're wearing a great suit today.
I tried to keep up with you.
But I'm sure you tried it on before you want to go to the store, you want to feel the material, you want to try it on. And I think a lot of the consumer really feels that way, particularly in the categories that we serve.
When you think about the shopping experience and how that's changed, because the consumer is having that discovery moment that's online, but then having the tangible, let me feel the material, let me see how it fits. They're having that moment in brick and mortar and IRL. How do then you look at the success rate for these companies? What are they gauging that experience, or at least using as their barometer to say whether or not it was actually a success for those consumers?
Well, first of all, just if I took one quick step back, part of what we're doing as the developer or the owner of the shopping center, in order to make our facilities that much more attractive for the consumer, mm-hmm. is we've recognized that the shopper's not just coming for the shopping experience. They're looking for other things to do when they're there. They're looking for better places to eat. That's the number one request we get is, wow, it would be great if we had better restaurants.
Are there more restaurants coming in?
And we're delivering better restaurants. Yeah. So from Shake Shack to Dallas BBQ, all these different brands that are coming in, whether they're sit down, they're quick serve, the restaurants really find in the outlet space now, because we're catering more to a local customer than we ever did before. Mm-hmm. We used to be so remote 20 years ago because of the competition, the sensitivity to different wholesale channels, then now what we're finding is we're able to build our centers a little bit closer in, and we have that benefit of a local consumer. The local consumer is looking for more amenities, more food, more entertainment, and that's what we're delivering in our centers. Mm. How is it reflecting? The retailers are really responding because they understand you're not just a place where people are going to come and gather and shop. This is a place that people can do other things there as well, and may come and visit us far more frequently, stay longer when they get there, and ultimately the combination of those two, we see them spending more money.
Because of my own experiences going into Tanger Outlets over the years, I'm always fascinated, and we typically are able to get an update from you on just what the most attractive real estate looks like for Tanger in this environment, where you would like to build more out. What does that pipeline look like?
Well, so we just built a shopping center in Nashville, which we opened up in October of last year. And if you take a look at the Nashville market, that is the perfect location. It's under-retailed from a full price point of view. We are 12 miles outside of the city. We're on a major interstate that connects a couple of major cities together. So there's that tourist traffic that's coming into Nashville. We're accessible to downtown, but more importantly, a lot of the population growth that you see happening in Nashville right now is happening in that southeast corridor where our shopping center is. So the combination of great local catchment as well as a great tourist population with not a tremendous amount of competition in the marketplace for shopping, we find that we're seeing a lot of that customer come to our center.
Just lastly here, you mentioned more and better food options. I mean, what is going to keep the customer within that premises for a longer period of time? Do you need to bring in more gyms or more grocery stores to make sure that people, while they've already driven the car there or taken the Uber ride there, that they're making the overall payoff for the trip make sense?
Well, that for sure. And that's what we're seeing is our customer is really looking for a number of reasons to come. For us, the best thing they can do is park their car once and then be able to service all of those different categories that you mentioned. I'll give you a great example, Sephora and Ulta. Here's a category, health and beauty, wellness, that has not had a lot of traction or a lot of opportunity in the outlet space, but now it's something that's critically important. Sephora, the Sephora stores, that we have 5 of them currently under construction. We've got a number of Ultas in our portfolio. The customers coming, they come far more frequently, and once I get the Ulta consumer's car in my parking lot, that's a great business to business. Ulta brings other brands, but it also brings a lot of consumers. And those customers, oh, by the way, they've got a whole bunch of other places to shop, eat, and be entertained while they're there.
All right, I know the value of beauty, especially as a person who puts on makeup every day for the show. Thank you so much for joining us.
It's my pleasure.
Always
Thanks
great
for
to see you. Stephen Yalof, who is the Tanger CEO, joining us here on Yahoo Finance. Switching gears here, shares of Edgewell moving lower after the company reported mixed results. The personal care brand missing on revenue as shoppers continue to tighten their wallets. For a deeper dive into the results, I'm joined by Dan Sullivan, who is the Edgewell Personal Care CFO. And I might mention as well, going to be the COO very soon. Dan, thanks so much for taking the time and joining us post earnings here. Just want to get your general read on the consumer as it pertains to Edgewell and, of course, the beauty and self-care products that this brand is known for as well.
Yeah, great to be with you. Look, we had a good quarter. We're a bit disappointed in the initial stock reaction, although it's coming back. We posted 1% organic growth in the quarter, which was in line with what we had expected, underpinned by really strong market performance internationally, 6% growth, equally driven by volume and price. So really strong results. I think that the key financially is another quarter of margin inflection, 175 basis points of year-over-year margin gains. That fueled 20% plus EPS growth, and we took our profit outlook, EBITDA and EPS, up for the full year. So look, it's a tough environment for sure. We're certainly hearing that from other guests of yours as well. We're pleased with the performance, though, and I think it's indicative of how well the team is performing and really good in-market execution.
When you think about the kind of forward guidance that you're giving the street right now and really kind of trying to best anticipate how the consumer may continue to moderate, there's weakness at the low end and, of course, now even more pressure on the middle tier. How are you kind of factoring that into your guidance here for Wall Street?
Yeah, it's a great question. Look, there's no doubt the consumer is under increasing pressure. I think all of the data points to that outcome for sure. I think what's important to note for our business is we operate in largely non-discretionary categories. We are, for the most part, in the middle of the price tier, so we're certainly not at the top of the price tier. And we're non-discretionary, right, in use for the most part. And so I think there's a little bit of protection around our business just by the nature of the categories in which we compete. And even a category like sun care, where you might think about some consumer sentiment could bleed into behavior, we're super excited. We're simply not seeing that. The consumer continues to be unwilling to sacrifice on experiential spend, travel, resort, vacation, fun in the sun. We just had a category in the U.S. sun season that was up 2% in its biggest quarter of the season, and we gained share in that quarter. So is it getting harder? For sure. Is the consumer under increasing pressure? For sure. We like our positioning as far as the categories go, and we continue to focus on that which we can control, right? Take costs out of the business, be super smart where we invest, where we can get high return, and execute really well.
You know, one of the things that's going to be a major carryover from your current position as CFO into your new position at the end of the year as Chief Operating Officer is really the strengthening that you and the company are talking about in this operating model. Walk us through some of the changes that we should expect to see and how the consumer will kind of see the difference there coming from the company.
Yeah, I think the magic word here is accelerate. We want to take all that we are doing and do it faster. That is a reflection of our ambition in North America, where we've actually seen really good growth in our right to win portfolio, sun care and grooming. And now we are looking to accelerate performance in shave and in fem care. I think back to the operations point of your question, we have been incredibly good at taking cost out of the business. We've averaged somewhere around 250 basis points a year in pure cost takeout. That is a good proxy for how we thought about it going forward. And the answer today is we want to do that even faster. We want to create more dry powder that we can invest behind this portfolio of brands. So I think what you will see from us is a bigger focus on accelerating speed, a bigger focus on execution. We have to simplify the supply chain. We have to perform better. We have to execute better, and we have to be a better service provider to our retail partners.
There was a push through, and even though you did see higher volumes in some categories here, and I'm looking at the wet shave in particular because I need to shave so much just to look presentable on air here. Higher volumes, but also higher price. How much more price do you think you need to push through at this juncture?
Yeah, look, I think the pricing environment is a tricky one. We can all agree the days of commodity-based, inflation-based, broad-brushed pricing, those days are gone. But equally, I think brands that can win on shelf, brands that have resonant demand with consumers, brands that can bring innovation to the shelf, they have a right to take price. They have purchasing power. We see that in various spots within our portfolio, but our application of it from here on out will continue to be much more surgical, much more where we are strong on shelf and in market, and much less what we've seen in the previous couple of years around just broad-based inflationary pricing.
I guess selfishly, Dan, are my razors going to cost more at Christmas time than right now during the summer?
We don't do seasonal pricing, so you would not see a spike at the Christmas time. I'd also encourage you, shop our kits. We do a phenomenal job around shave and grooming kits for the holidays. Might be something you'd be interested in.
Yes, indeed. Dan, thanks so much. Always appreciate you taking the time here with us, diving into some of the earnings results, and congratulations as well on the new role yet to come later on this year, as well as the new appointment of Francesca. Dan Sullivan, who is the Edgewell Personal Care CFO. Thanks, Dan.
Thank you.
Certainly. Much more on wealth after the break. You're watching Yahoo Finance. We had three big consumer names report earnings this morning: Uber, Yum Brands, and Molson Coors. Here's what you need to know. Ride shares and food delivery are still in the budget, according to Uber, as quarterly results revealed increased demand in its second quarter. Gross bookings for mobility, which is driven by their ride-sharing unit, grew 23% year over year, while gross booking for delivery grew 16%. For those driving passengers and delivering food, this translated to $17.9 billion in earnings, including tips, during the quarter. And that's up 19% compared to the year prior. Uber did cite, quote, commitment to affordability and increased discounting on its apps as part of the driver of demand for consumers. Another key report for consumers this morning: Yum, which owns KFC, Taco Bell, and Pizza Hut, saw a bigger than expected fall in same-store sales across its U.S. stores. But the one bright spot in the report: Taco Bell. The chain's value meal deal, the $7 Lux Cravings box, helped grow U.S. same-store sales by 5% year over year during the quarter. Meanwhile, KFC and Pizza Hut, which also often offers promotions, aren't capturing the consumer's attention nearly as much. KFC and Pizza Hut both saw same-store sales fall by 3%. And you can't have your food without a little drink. Why not? Molson Coors is benefiting from that. The company saw strong demand globally. Good news for investors who are rewarding the stock today. It's up 6%. But looking at the U.S. specifically, brand volumes were down 7.8% in the company's second quarter as Americans cut back on more premium beer options. What these results tell us is that most consumers are looking for value and choosing to get more for their money over some of the premium options out there. Well, after a big slide in the markets, investors are wondering, do I buy the dip? To help assess the possibilities, we bring in Yahoo Finance's data and markets editor, Jared Blickery, with the data perspective here. Jared.
Thank you, Brad. And set your stop loss orders. Check your VWAP. We've got some technicals to analyze. No doubt, there was a lot of fear during Monday's unwinding, but the S&P 500 is only down 8% from its mid-July record high. The big question on every investor's mind is, are we going to bounce from here? Now, the Nasdaq and the S&P 500 have declined into an area called the 200-day moving average. It's fairly simple to compute and describe. You take the average of the prior 200 days and plot it on a chart of market prices. You're going to notice that price moves around the moving average. So just give me a minute here. Here's the here's the Nasdaq. Here's a year-to-date chart. And on top, I'm going to plot the 200-day moving average. And you can see it's a little bit above here. But if I put on candlesticks, which shows intraday price action, you can see yesterday touched that line exactly and moved off of it. And then if I show you the Russell 2000, for instance, a different market, you can see how price is largely above it. Sometimes it goes below it. And you can also see this with the Dow as well. Now, a lot of times price is going to catch up to the moving average line. And when it does, you might consider, all right, that's a mean reversion when the price goes too far too quickly. It tends to snap back to the average, and traders look at other time frames too. The 5, the 10, the 20, 50, and 100. Those are all settings that traders use. So here we have the 50-day to look at. It moves more quickly than the 200-day, and sometimes the two averages are going to cross. And let me show you what that looks like. So here's the 50. You can see it's moving a little bit quicker, that purple line right here, in relation to the 200-day. And sometimes they do cross. You're not seeing it here exactly, but let me show you a longer-term view. Here is a 2-year. And when they cross like that, it's called bullish, when it crosses like that, it's called a golden cross or a death cross. So putting it all together, traders will look for the slope of the line, and if it's moving up, they might look to put in a trade on it off of one of these averages. Short-term traders are going to look at the 5-day moving averages, and some of the longer-term traders are going to look at some of the longer ones. But all in all, just another piece of the pie to help you navigate these tumultuous markets.
Jared, thanks so much. Excellent breakdown. Certainly appreciate it. Yahoo Finance's own market and data editor, Jared Blickery. All right, everyone, we'll be right back on the other side of this short break. You are watching Yahoo Finance. Stocks selling off over the last couple of trading days, and one of the reasons cited is the unwind of the so-called carry trade. To discuss Yahoo Finance market domination, co-anchor Julie Hyman has more.
Hi there, Brad. So let's explain, first of all, what we're talking about when we talk about the carry trade. You've probably heard that phrase a lot more in the past few days as we've seen the big sell-off in risk assets, in U.S. equities, et cetera. So basically what it is people borrow money in a low interest rate currency, and then they borrow, and then they use that to buy assets where rates are higher, for example. So one of the classic places that we've been seeing that is people have been borrowing in Japanese yen and using it to buy assets elsewhere, including, by the way, Japanese equities, including in other areas from Mexico to here in the US. So sort of funding more speculative trades with this very low cost currency. So that's what we've been seeing happen. The unwind of it is when all of those big bets had to be reversed. So first of all, before we take a look at this, I do want to look at what we have seen from the Japanese yen, because the movement in the yen is really what spurred this unwind. Basically, this big decline, which is in the dollar versus the yen, came after the Bank of Japan last week raised rates there to 0.25%. So that seems very low, but we had seen the Japanese, the Bank of Japan holding at 0 to 0.1%, and even before the spring had negative interest rates. So this was a big shift coming from the Bank of Japan. That is what has spurred that big move, especially as it is in contrast now with the Federal Reserve, which is getting closer to cutting rates. So that sort of duality between the two is one of the things that has fueled the big move. So let's go back to that other chart that we were looking at. This is one of the ways to try to measure the size of the carry trade. And it's tough to do here because there's no sort of perfect way to do it. But this uses a Commodity Futures Trading Commission data here and looks at loans in yen. This is between banks, the purple line down here, and then non-bank financial institutions, things like hedge funds, for example. And obviously you can see the line has been going up and really spiking here, and that the share of the hedge funds and other speculators who have gotten into this market has been increasing. In as of March, which is the latest that we have the data, 21% higher from 2021, $1 trillion is what this lending had been. So you see that sharp move in the yen that then leads to some of this unwinding, and the size here of it gives you an idea as to why it contributed so dramatically to some of the selling, at least, that we saw here in the U.S.
So is there a belief that the unwind is finished?
Well, maybe going towards being finished. We talked to Ed Yardeni of Yardeni Research the other day, and he expressed some optimism that it was getting closer to working itself out.
And now with the central bank tightening while other central banks are easing, the yen suddenly had a big move to the upside, and that strength really led to a lot of margin calls of these speculative positions. And I think the proof of that is that it's a global sell-off, which suggests that a lot of money was raised in Japan at zero interest rates and used to speculate in other parts of the world. So I think that's all coming unglued, and I think it's a lot of margin calls, and I think it's going to happen pretty quick, and the unwind should be over by the end of the week.
So you heard him there say the unwind should be over by the end of the week, but there are some others who think that it could be over quickly, but then there are some who think that this unwind could take quite a bit longer to occur because of the sheer size of it. There's a lot of folks this week who are trying to figure out exactly how it's going to play out, but it is definitely not unanimous in terms of thinking it's going to be quickly done, Brad.
All right, I am pro quickly unwind, perhaps here. Julie, thanks so much for breaking that down. Appreciate it. Well, if you opened up your investment accounts yesterday, your heart may have skipped a beat as the Dow tumbled over 1,000 points as part of a global market sell-off. And if that freaked you out, well, maybe you panicked and made decisions based on fear and emotion. But here to dig into the psychology of money during a downturn And to talk about what people tend to do during these time periods, we've got Michael Learsh, who is the head of advice and planning at Wells Fargo. Michael, thanks so much for hopping on with us here. Okay, so let's just talk about the psychology that people go through when they hear information or they first see kind of these jolting numbers that pop up on screen about where the market is poised to open up, and then what's actually happening during the trading session, and then the broader context of it all.
So it's interesting that you highlight this, because the broader behavior that you typically see is something called doom scrolling. And I'm sure you're familiar with that, as are many of your viewers, which, to your point, you look at your accounts and you just keep going back and looking, how much have they fallen? How much have they fallen? And typically that leads to three types of behaviors. The first is what we call in behavioral science risk aversion, and that is really this aversion to uncertainty. So human beings are uncertainty reduction machines. We want to eliminate uncertainty in our lives, which is ironic because it's uncertainty that actually gives us that, think of it as value in the market, because we've taken that risk and that risk has paid off. So typically that leads to something called action bias, which means you want to de-risk. And you saw that a lot in the markets in the last couple of days. Loss aversion is another one that comes up, which is fear of loss. So in behavioral science terms, losses hurt twice as much as the equivalent gain feels good. So human beings don't like to lose. So what we do is we try to think of it as investments or ways to park our money that don't lead to at least immediate losses. And the last one that I would highlight that is really systemic in times like this, and you heard it in the former segment, which is this idea of herd following. So once one person does something, then another person does it, and then it can become a global phenomenon quite quickly. And so when you think of that herd following, it's really important to be introspective and say, now, is the herd that I'm following, are they on my time horizon? Are they really executing on the trades that matter most to me when I link them back to my goals in terms of what I'm trying to accomplish financially speaking? So you really have to ask yourself some critical questions before you start following that herd.
What are the ways to keep your decision making in check, knowing that these are the tendencies that might come about naturally, just as part of our psychological or just the pathway of thinking?
So three things that I would highlight. The first is to keep yourself in check. It's always critical to have a collaborator, and ideally a human one. So whether that's a colleague, a spouse or a partner, a professional, they can help keep you in check and make sure that you're not think of it as overreactive decisions based on your gut, and that's really in line with your goals. The second piece that I would really highlight is that you have to go back to what you're accomplishing. So name that goal. Are you trying to grow your money? Are you trying to save or invest for something specifically, a big purchase, a home, whatever that might be? And really think about the time period and the dollar amount that you're targeting and whether you're really in a good place to get there. And the last thing I'd mention is really make a plan. You don't want to be making decisions in the absence of a plan. So if you made a plan and you feel like you're still on track to achieve that plan and you have enough, stick with it. If you don't have enough, then you may want to make some strategic changes or some tactical changes in order to get there in think of it as more certain way, because we are all that uncertainty reduction machine at the end of the day.
Certainly. Just lastly, while we have you here, Michael, different generations of investors have experienced different shocks in the market. Is there a way that you're seeing psychology differ across generations with more events that we continue to navigate through?
Absolutely. So there's a key one, which is, as you well know, younger investors tend to really interact more on their mobile devices, whereas older investors tend to interact more either with a human or on their desktops. And that actually is research that has shown that mobile devices create more of an action bias than a desktop or a human being might. So it's something to keep as a major watch item as you're entering markets and uncertain ones. Where are you really leaning into your mobile device versus other forms of making these types of investment decisions? And really take a step back, take a pause. Our mobile devices, we like to text on them. We like to do things that are very immediate, scroll social media videos. but that's not how we should be making investment decisions. So just keep it as a watch item.
You mean a meme shouldn't be the core focus of my investment decision making? Michael, my goodness, come on now. Michael Learsh, who is the head of advice and planning over at Wells Fargo. The memes are fun sometimes, though, Michael. We got to admit that.
They are.
Appreciate it.
Sure.
Thanks so much for taking the time.
Thank you.
Certainly. We've got much more wealth after the break. You're watching Yahoo Finance. Sharpen up them pencils. It's time to head back to school. That's right, back to school season is here, and students are ready to take on core subjects like math, science, and language arts. And while these classes are a mandatory part of our curriculum, one subject remains absent from many schools: financial literacy. For more on financial literacy in schools, I'm joined by Sharon Kent. She's the program director for Our Money Matters, an HBCU Community Development Action Coalition program. Great to have you here with us. Okay, so as we're getting ready to go back to school, where are we seeing considerable changes being made to address the gap in financial literacy, and where do we still have some work to do here, Sharon?
Well, there's plenty of work to be done, that's for sure. And I do know that in some states, the local governments have mandated financial literacy in some high schools. But I really believe that financial literacy begins at home and is and then from home, then it's, you get more of it as you go to school. And so one of the things that I've seen in my work is by the time students get to college, they've missed out on so much financial education. And here's some things that, as you put up on the screen, some things that the school should teach to help empower young minds, preventing future financial mistakes, which is critical because typically the generation prior to made a lot of those mistakes. And the goal is to make sure that our students today don't make those same mistakes. And one of the other things that we can do with good financial literacy, solid financial literacy, is helping close the racial wealth gap. So all of those things are important and help create an environment where kids can learn more about financial literacy. One of the things that, as you said, as students go back to school now, some of the things that parents can do at home is start talking about finances and make personal finance a part of the daily conversation. When they take their kids to the grocery store and talk about the cost of certain items, helping kids understand the difference between wants and needs and things like that. And so we can start the conversation at a very young age and carry it through middle school, high school, college, and beyond.
Right.
And so those are some of the things that we can do right now.
What are some of the core financial pillars that should start within the household, and then where should schools and programs in their curriculum be picking up on the other side?
Yeah, so coming up with things, teaching kids the difference between needs and wants, that's always a good thing. And then some things that they can learn in school are understanding the basic value of money. Money is a tool. How do we use it effectively? How do we grow the money? Introducing saving and spending to help the students understand once they get money, whether it's from getting allowances, from doing chores at home, or even the monetary gifts they get in their birthday cards from parents, how to save that money. And then start introducing some practical skills such as budgeting, starting that at a very young age. Middle school, you're looking at maybe opening up a savings account, learning about simple interest and the importance of savings, and then having a basic understanding of credit cards and debit cards. What's the difference? What are the pitfalls? What are the advantages of either one?
If there was one core, perhaps, and all of this adds up, right? It's aggregated to make sure that there's a holistic understanding that someone has by the time they graduate high school and are ready to go to higher education in whatever form that may be, could be a vocation or whatever. As we're trying to become more perhaps systemic internationally and nationally specifically, what is the one big takeaway that and common understanding that every student should have prior to making that transition into higher education and then later on into just beginning a successful financial life?
I think there's not just one thing, because the idea of personal finance encompasses many areas. But understanding credit, your credit score, the importance of the credit score, and how it's going to impact your interest rates on things as you go into wanting to buy your first car, your first home, and understanding some tools about how interest rates work, especially on your student loans, and then understanding investing, the difference between the stocks and bonds, mutual funds, and being able to make those kind of sound financial decisions that will put you on solid financial footing as you go through college and beyond. And the bottom line is that all of this education, starting from elementary through college, will help not only this generation, but the next generation to come.
Sharon Kent, Program Director for Our Money Matters and HBCU Community Development Action Coalition Program. Thank you so much for taking the time here with us today.
Thank you.
Certainly. Well, financial literacy, as we were discussing, isn't just a classroom problem. It's also a challenge for parents. Parents are taking it up on themselves to teach their kids about managing money, budgeting, and saving. So what's the best practice to teach your kids about finances? Here to weigh in is Yahoo Finance contributor Ross Mack, a man that owns at least one car that he teaches his kids all of these financial literacy tools and equips them for the future as well. So Ross, take us into where these conversations can start.
I echo everything Sharon said, right? I think it's very important that we as a community understand that financial literacy is its own language. Therefore, the earlier we learn how to speak it, our family and our kids will have a much higher likelihood of being fluent in that language. And that's why, and I love what you said, like I talk to my kids about finance every morning. And I think that one thing you got to understand is our kids are going to learn things. They're an empty sponge, right? They're soaking up everything in the world around them. And so they're going to learn things good and bad just through osmosis, just by being, just being around it all the time. And so when we're talking about finance, the good thing is if you're showing them good money practices, well, guess what? They're going to now inherit that as well. And so unfortunately, if you're bad with money, your kids will also inherit that as well. And so I love talking to my kids about, the economy around us. I love talking to them, saying how much groceries actually cost. And let's talk about allowance. Let's talk about, hey, this toy is amazing, but did you know this is how much it costs? And more importantly, when my kids were saying, all I want to do is go on YouTube, well, now we're talking about how do we actually own YouTube. And so now we're talking about investing and we're talking about different stocks. And so I think it's important that we talk to our kids and put things in their own language, right? You want to equate the world around them to kind of great money practices. And so when we're talking about, hey, these are the apparel brands that you're wearing, right? We won't necessarily say their names, but you have the ability to own this, or this social media platform, you have the ability to own this. And I think when you're talking to them early on, that's something that I find to be very important. And that's why I have a new book, right? Seen right behind me. It's called The ABCs of Future Millionaires. And what I love about it is we're putting things in a very easily digestible manner, right? So when we're talking A, assets, B for bank, E, economy, F, FICO score, not only are we going to say what it is, we're going to have amazing illustrations, but we're also going to say what a FICO score is in a language that the kids can understand. It's a report card for how well you're going to pay back the money that you borrow, right? E for economy. The way people in a place make and spend money, like buying toys or selling lemonade. And so when you're putting things in a more practical, easily digestible manner, it gives kids the ability to start learning great money practices that they will eventually be great when they start making their own money. And, because when you think about the statistics, the average person don't have $1,000 saved. And so it starts at home.
Yeah. Ross Mack, thanks so much for taking the time. Congratulations on the new book. And everyone, viewers out there, you can be sure to watch Ross's podcast, Financial Freestyle. Check it out on streaming platforms and Yahoo Finance's homepage. New episodes every Monday, 12 p.m. Eastern Time. Let's do a final check of the markets. We're taking a look at the major averages here on your screen. We are up across the board. Major averages trying to rebound from the down day that was Monday. We are up more than 1% across all the U.S. major averages. That does it for Wealth. I'm Brad Smith. Thank you for watching. Tune in. Market Domination has you at 3 p.m. Eastern Time with Julie Hyman and Josh Lipton.